twists and turns on the way. And the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg Terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Live from New York City this morning. Good morning. What a morning we've got coming up for you with an ECB decision just around the corner, and you'll hear from Chairman Powell. At the same time, you'll hear from President Lagarde. No complaints here. Futures unchanged on the S&P and the Nasdaq 100 unchanged as well. Off the back of the biggest one-day pop on the S&P going back to early August 10th, I believe. Yields look like this on 2s, 10s and 30s. Goldman Sachs changing their call. You've heard a lot about that this morning here on Bloomberg. They go to 75 for September from 50, and anticipate that maybe this Fed keeps hiking through 2023 as well. I think that's where the debate is at the moment. 343.53 on a 2-year. I think we can call a 2-year unchanged. One thing you cannot call unchanged over the last month has been the Japanese yen. Take a snapshot of foreign exchange going into this ECB call. Euro dollar slap bang on top of parity right now. Dollar yen 143.82, slightly weaker on the session. And Tom, this is happening. This is happening even with a bit of verbal intervention from Japanese authorities. Talking won't get it done right now. The issue at the moment, Tom, is action and policy. They're capping yields in the bond market. The upper band, I think, on the 10 years, about 25 basis points. They're keeping rates unchanged when everyone else is hiking, and that's why you're starting to see this yen weakness. Kit Jukes of SocGen this morning, I think, made a very, very interesting point about what comes next. He's saying this, Tom, for 2023, that what we're going to see is growth expectations elsewhere converge lower. And the Japanese economy starts to look a little bit more attractive, relatively speaking, as you look further out into 2023, Tom, as these central banks, including the ECB, tighten into economic weakness. The BOJ is not doing that. Kit's making the point that that's when the yen starts to get a little bit more attractive. That's not where we are right now, but that story could just be around the corner.
Yeah, there's a lot of talk about that, John. You've had big figure moves in these currencies, and there's a point where you step in and go the other way. But there's so much, as Council on Foreign Relations says in their 100-year issue, there is just so much uncertainty out there. I don't know when the when is of the when or how I can analyze the when.
143.80 right now, Tom, on dollar yen.
And an ugly chart, and there's a few others out there to go with it as well. We're going to dive in here to the EU and UK economics and the choices to be made, including in America. Jennifer McCown joins us, head of global economics at Capital Economics, formerly with the Bank of England as well. Jennifer, there's a wide understanding in America that the dynamic of West Texas Intermediate matters to Joe Biden, it matters to Jerome Powell. Brent crude is down 28% from the peak. Brent crude is back pre-Ukraine levels. Does that matter to Christine Lagarde and the governor of the Bank of England?
Well, it matters, but not as much as what's been happening to the gas price. And while that's come off, the wholesale gas price, while it's come off a bit lately, it's still, 10 times the pre-war levels. So that's a major issue in Europe at the moment, the one that they'll be focusing on. Yes, the decline in the oil price helps to take some of the heat out of energy inflation, but nowhere near enough.
Can you do real GDP analysis of Europe, or do you, with the huge inflation, are things so distorted that real GDP or nominal less inflation, the kind of traditional analysis, just doesn't work?
Yeah, it certainly makes things a lot more difficult. And I know some of the ECB's governing council members have said that at the moment it's as if they're in a dark room. So taking big steps in that situation is much more dangerous. And I think that's a really fair judgment of the situation. The high inflation level, the high inflation rates do make policy decisions difficult.
Can you give us a sense of just how challenging this moment really is right now for the Bank of England in the face of fiscal expansion, of expanding fiscal deficits, of Liz Truss about to explain how much she plans to spend, at least in the short term, to support households in the face of incredibly high natural gas prices? What would you be doing? Is the Bank of England just preparing to hike rates until the pain becomes too difficult for the economy to maintain any kind of momentum?
Yeah, well, the Bank of England's already said that there's going to be a recession. Unlike the ECB, it's been quite upfront about that and does intend to keep hiking anyway. I mean, the implications of this announcement from Truss today are a little bit mixed so far as the Bank of England's concerned. Really, on the one hand, if she caps energy prices, then that helps to ease some inflationary pressure in the near term, and maybe reduces the risk of sort of a wage price spiral in future, which is good from the Bank of England's perspective. But on the other hand, she's boosting demand, and that raises medium-term inflation pressures. And what we've heard from MPC members so far is that they're more concerned about that. They're more concerned about the likely upward impact on inflation from higher aggregate demand. So I think it just adds to the case for the bank to continue hiking pretty aggressively for now.
Jennifer, when you were at the Bank of England, have you ever seen a fiscal package this large, this untargeted?
Oh, I can't remember, but it really is large. We're looking at about 6% of GDP, I think, if speculation is correct, and that's really big. It's big by international standards. It's big by past standards. What we've got to remember is that the UK's actually done relatively little so far compared to the likes of France and Greece, where we've seen bigger support, price level caps already. So we really were waiting for something to come through, and it's good news for the economy and for households. But the real worry is that it doesn't seem like it's going to be targeted in any way, and also it's funded by borrowing probably rather than by a windfall tax as other economies and other parties within the UK have proposed. So there are some concerns about what this does in future to the public finances and the prospect of needing to rein in the years to come.
So we could see one of two things happen, or maybe both. High yields, seen that over the last month, or a weaker currency. Yesterday, sterling broke down to levels we have not seen since the middle of the 1980s, 1985. We took out the low of the pandemic in March of 2020, 114.06. Jennifer, is there a moment when you look at sterling and you start to worry? And is that moment now?
I think that moment's not now. The UK is not like an emerging market. We don't have kind of large debts denominated in foreign currencies, so it doesn't feel like we're kind of heading into a crisis point. I think in terms of prospects for sterling, market expectations for interest rates might have gone a bit far in our view now. So it may be that ultimately it turns out that the bank doesn't need to go quite so far as markets are pricing in.
Jennifer, that was brilliant. Jennifer, help us here with what you just said so everyone calms down. You studied with Wendy Carlin at UCL, who I know knows the x-axis. And the answer is, if we assume a war that's been 6 months old, the United Kingdom has had wars that were a lot longer than 6 months. You issue debt and move on. I don't hear a panic in your voice about the issuance of new debt given a war. Am I right that everyone should calm down?
Yeah, I don't think it's time to panic at all. But I think what I'm more concerned about is what the issuance of this new debt means for the future. I think it would be more sensible to impose a windfall tax on energy companies, of which there are very large ones in the UK, to fund this. I don't fully understand why that hasn't happened. And I think the risk really is that there needs to be some consolidation of the public finances in a year or two to come.
What kind of inflation rate is the United Kingdom looking at a time when Citigroup put it somewhere in the range of potentially 22%?
Yeah, I think lower than that. It depends a lot on what Truss announces, really, but we're probably looking at a peak of perhaps more like 15%. But these rates clearly are astonishingly high. Inflation should come down pretty sharply next year, not least because of the very strong base effects that we have in energy prices at the moment, statistical effects. But still, there's little prospect of it coming back down to target within the Bank of England's normal framework of around 2 years.
Jennifer McKeown, we appreciate your time this morning. Really important morning for the UK. Jennifer McKeown there of Capital Economics. We're going to hear from Prime Minister Truss in any moment now, any minute now in Parliament, Lisa. And I don't think you do just move on, Tom. And this is the problem. You don't just move on. If you're going to take on uncapped liability, how can you move on when you don't know what's going to happen with gas prices? And I'd go a step further. What the Treasury's potentially putting themselves on a hook for right now is to pay the additional margin that the consumer would be paying, the additional profit margin to the energy company, and then not follow that up with a windfall tax.
Yeah,
now, Tom, what's that going to mean further down the road when we have some kind of fiscal consolidation in the UK to mop some of this mess up? Who's going to pay for that?
In your reading, who is holding back a windfall profit tax in the United Kingdom?
The Chancellor?
The Chancellor?
The Prime Minister?
The Prime Minister. Everyone seems to be on board with that. Their argument that they're making is the same argument the previous government, the previous leadership made. And Lisa, it's the worry that you don't get investment at a time when you need investment. I'd argue that things have changed a lot, and you can see how much they've changed in the last couple of days when we're facing down a plan from authorities that could amount to 6% of GDP. And Lisa, it's not like the furlough program. The furlough program in the pandemic was very targeted. That's not what we're going to hear.
So I think that it's fascinating to look at the transformation of the concept of conservative politicians, right? There is this idea of conservatism when it comes to business and profits and how you intervene on that side, but there's not the same conservatism with respect to borrowing, with respect to some of the support to households in a time of crisis. And this conflict is becoming more and more acute as you deal with a fiscal backdrop that looks really daunting at best.
Now, of course, we're basing our assessment on leaked reports of what we will hear in a couple of minutes' time. And Tom, it could well be different. Maybe the Prime Minister's had a change of mind in the last 24 hours and we'll hear something different. So all ears for what this plan actually is. But what we've been led to believe is the plan, Tom, is very, very big.
Yeah, absolutely. John, I'm watching the monitor here. The Prime Minister just stood up, but then she sat down because she was listening to you.
You think she's editing it, TK?
I think, no, she's getting up again. I love this, John. It's so different than America. I'm sorry.
She's going to speak at 9:08.
Well, the Prime Minister's starting
right now.
She's going to
speak when Powell and Lagarde speak. She's going to speak.
I think we can take a listen, Tom, if they've got the sound of this. No, they're going to the music for the break. We got the Prime Minister.
The new energy price guarantee that will give people certainty on energy bills. It will curb inflation and boost growth. This guarantee, which includes a temporary suspension of green levies, means that from the 1st of October, a typical household will pay no more than £2,500 per year for each of the next 2 years while we get the energy market back on track. This will save a typical household £1,000 a year. It comes in addition to the £400 energy bill support scheme. This guarantee supersedes the Ofgem price cap and has been agreed with energy retailers. We will deliver this. Mr. Speaker, I will make way in a few minutes when I have made some progress. Mr. Speaker, we will deliver this by securing the wholesale price for energy while putting in place long-term measures to secure future supplies at more affordable rates. We are supporting this country through this winter and next, and tackling the root causes of high prices so we are never in the same position again. For those using heating oil, living in park homes, or those on heat networks, we will set up a fund so that all
Prime Minister, sorry about this. Can I just say, I don't want a running commentary from here and giving me the advice. I certainly don't need it. Prime Minister, I don't want to interrupt you. It's up to you to give way when you feel it's appropriate. But just to let you know that it is now being printed, the WMS, and I'm hoping they will bring it into the chamber for everybody to see. Prime Minister.
Well, thank you. Thank you, Mr. Speaker. For those using heating oil, living in park homes, or those on heat networks, we will set up a fund.
What do you think is the future of the US dollar? For the next 50 years, you are absolutely going to see a monetary revolution. But what you're going to see in the short to medium term is the strongest fiat currencies will hold on for much longer than we probably admit.
So that all UK consumers can benefit from equivalent support. I'll give way to the honourable gentleman.
I thank you for giving way. National Energy Action estimate with the cap at the current level are 6.5 million households in fuel poverty. So raising the cap to £2,500, how many more millions of people will end up in fuel poverty, does you reckon?
Well, Mr. Speaker, we are taking action to help people on the lowest incomes through universal credit, and we are also supplying £400 through the energy bills.
The Prime Minister under pressure here in Parliament, unveiling her plan to offset some of the pain on energy in the United Kingdom. I'm very pleased to say that standing close by is Lizzie Burden. Lizzie, you've been listening to some of this, you've read the reports over the last couple of days. What have we heard?
Well, Liz Truss is saying that the plan is to limit the typical price of energy for a household to £2,500 a year. Remember, bills were meant to go up 80% next month, so this is going to be a huge relief to households. It's convenient, isn't it, that it's going to last for 2 years from October when there's a general election due in 2024. But it is going to be a big relief. The question is, how sustainable is this? If this is the new normal, we had Philip Hammond, the former Chancellor, on the programme, and he was saying, people need to change their behaviour, right? The market needs to adapt, but the government's going in and subsidising the wholesale cost.
Right.
So it's yeah.
Lizzie, is this bipartisan or is this the Conservatives alone?
I think I was having a discussion with an economist this morning about this. Whoever was going to be Prime Minister, regardless of whether it was Rishi Sunak or Liz Truss, whichever party they are, the parameters of this situation mean that this was probably the only likely outcome. We've got the energy crisis is at the heart of the cost of living crisis. They had to stop inflation going above 20%, as Goldman Sachs had predicted. The analysis from Bloomberg Economics is that this is going to mean inflation has peaked.
So, Lizzie, there is a lot of agreement that there needs to be some fiscal support for households. There is not necessarily agreement on simply abandoning the idea of a windfall tax. Why is that not on the table at all, even though a lot of people are concerned about capital flight, about foreign investors not financing this growing fiscal deficit?
I mean, Liz Truss was very clear in the Prime Minister's questions yesterday, her first standoff against Keir Starmer, that she was not going to use the windfall tax on energy companies. But then later in the day, it seemed that she would continue Rishi Sunak's level of 25%. And perhaps what she meant by that was that she wouldn't increase the rate beyond 25 or extend it to include power generators. So, we've talked a lot about the difference between campaign economics and government economics. It's happening across a range of other areas, not to mention how they're treating the Bank of England, but this might be another one. The position on the windfall tax isn't as clear as you might think.
Well, the Prime Minister said just this: no windfall tax to fund the energy support package. She said the Chancellor will set out the cost in a fiscal statement this month. Later this month, Lizzie, when we hear from the Chancellor, how big is this? I mean, I imagine they can't even give us a number, because surely this is dependent on what happens with gas prices.
Indeed, and that's what's going to be so scary with the charts that are probably projected on the walls at the Treasury. So much of the tab that they're picking up is unknown. We had Hugh Pill, Chief Economist of the Bank of England, before lawmakers yesterday, saying that Goldman forecast of 22% was plausible, given what could have happened in wholesale gas markets. So, yeah, the Treasury is taking up a ginormous, unknowable tab here.
And doing it over 2 years as well. Lizzie, thank you. Lizzie Burden on the latest in London. 2 years, Tom. An uncapped liability potentially for 2 years. And the hope is, I imagine, that gas prices come down and that liability falls. But this is going to be very interesting to see what the Chancellor says later this month when the Office of Budget Responsibility comes out, Tom, with some estimates on what this all means.
And also what the Bank of England will do and how they will respond, how they will adjust to this. And John, I just have to say, there's just so many variables of uncertainty. I think the punditry and the gaming of it is, frankly, pretty useless. A lot of it depends on the economist Putin in Moscow.
Well, that's something that we can all agree on. it comes down to gas prices. And Lisa, that's going to dictate the cost of all of this as well. And whether this is eventually complemented with some kind of demand destruction, something to curtail demand in the UK as the Europeans are planning to do so.
It's an important point, especially because Ed Morse, the person we've been talking about all morning of Citigroup, who got the call right with respect to oil prices and gas prices, is looking at the demand destruction in the United States as markets working. What happens when you interfere with markets? Because you have to. But where then do you add the extra consequence of demand destruction that's required to get back to some sort of normalcy?
Joining us now is Katrina Dudley, Portfolio Manager and Research Analyst at Franklin Mutual Series. Katrina, fantastic to get you with us on the programme. Dario Perkins this morning out on Twitter of TS Lombard said this: the 2010s, tight fiscal, easy monetary, yields at 800-year lows. 2020s, easy fiscal, tight monetary, yields at ... question mark. Katrina, what does all this mean for the bond market?
For the bond market perspective, we're looking at rate hikes that are unprecedented in terms of what we're coming from. We're in a situation where we're talking about inflation. 2 years ago, me talking about inflation rates of 20%, which we were just talking about in terms of the UK, we wouldn't even think that that was on the horizon. So from our perspective, it's a new economy, it's a new normal, and it needs a different type of analysis in order to adjust.
Can they issue the bonds with impunity? I mean, what's the so what of the amount of gilt bonds they will issue?
There's common sense. There's the need to ensure that there's a confidence in the payback. Look, obviously, I think that you've obviously seen people around for so long, the UK, that isn't going to be an issue. But the fact is it's not quite the wartime economics that people are thinking of, where you've had past bond issuances done in response to wartime efforts. This is really done in response to this energy crisis and the inflation it's creating.
So you're not linking what's going on in the United Kingdom to the war in Ukraine?
I think that you are seeing the fact that people are realizing that this dependence on gas, the dependence on Russia is really hurting the economy. I think there are two things that need to happen. First of all, you need to get people being responsible for their own energy usage and realizing that energy has a cost, and you need to make sure that there is some level of demand curtailment that comes from having high energy prices. So that's the number one. Number two, we really do need to make sure our energy companies are helping us transition away from this dependency. And that means you can't have those windfall profit taxes that a lot of people are talking about, because we need these companies to invest. They need to be the partners alongside us in enabling this energy transition that has come to a head as a result of the war.
Which really raises a question about fiscal policy and just domestic policy in general with respect to the strength of an economy and the strength of a nation as an investment thesis. How long can the U.S. remain the one shining beacon amid a lot of pain that it has been over the past couple of months?
Let's just take a look at the U.S. market. You have energy security, you have defense security, and you have markets that are operating as they should. If we switch that conversation over to Europe, what we're starting to see, as we've talked about repeatedly, is there's the defense security. That spending needs to happen. That has obviously got implications from a fiscal point of view. We have energy security, and I think that we need to be considering that needs to happen. That needs to happen in partnership with commerce. Finally, we need to have responsibility. We also need to make sure, because in Europe, we're coming from a time where we've just had such divides and we've just had so many of these political parties arise. And I think that this high inflation, the haves and the have-nots, is really going to come into play and really change the political landscape further over the next 5 to probably 10 years. I would finish off with the one good thing about this policy I do like is Liz Truss is only doing this for 2 years. And while people are commentating that happens to align with the next general election, she also is not putting a hamstrung and basically boxing in her predecessor, or it could be her as well, into continuing these policies. And I think that that's really important, because we want to roll these things back if the market starts working the way we think it should.
Okay, so Katrina, what's the level where you would feel comfortable investing in sterling, investing in 10-year UK gilts?
In terms of the currency, I think that, the euro's at parity, for example. You look at where the British pound is. I think that there are always opportunities. I tend to bring things down to the stock level, and so we're looking for opportunities in UK stocks where we think the market has really over-penalised them against this kind of negative backdrop.
Katrina Dudley, thank you for responding to all of this. The Franklin Mutual series, the Prime Minister of the UK, Liz Truss, just moments ago. No cost-free options in the global energy crisis. If we were to define this morning, and the decisions that need to be made, they're not the optimal, the best decisions, Lisa, they are the least worst decisions they can make. And that's the opportunity set, the decisions in front of them. What's the least worst? That's a tricky position for anyone to be in, and that's what we talked about all yesterday.
Has there ever been a prime minister who came into a worse economic backdrop than Liz Truss is right now?
I thought Theresa May had a difficult hand. Said that yesterday, didn't I?
Yeah, I mean, this is to me a real question.
Liz Truss, this hand is really, really tough. What other choice did they have but to come out with something like this?
John, I've been thunderstruck by the last 48 hours. I feel like a complete amateur. You've lived this. I was absolutely stunned at the diversity and the age of this cabinet and this prime minister. It is so radically different than America.
Conservatives have a history of that, Tom.
Stunning.
Yeah, I think anyone who's been following the Conservative Party for a while, they have a history of that, Tom.
I think the youngest person, John, we have in Washington is 75. I'm kidding, but, it's been a change, John. And, she's stepping forward here. What's the next step for her, though, John? I mean, what's after this energy announcement? Then what?
I think it all depends on what actually happens with gas prices, because although they've capped things for the British consumer and they're trying to help British business, Lisa, the problem is if gas prices keep climbing, and I have no idea if they do or not, that's going to dictate how much they have to cover to the energy companies. The more money the energy companies make, the more pressure there will be to revisit that idea of a windfall tax, which is something currently, which they've explained again this morning, that they're against.
And there is this idea, we were just talking about that these energy companies need to be part of the transition away from energy dependence to a greener reality. They need to invest, but what's the incentive going to be, right? I mean, if you're plugging that gap, if you're giving that money to them, how aggressively can they hire in a deteriorating economy? How much can they put that capital to work to really get a different kind of energy system? I mean, it just creates a whole host of very complicated issues.
Do you think that the next Bank of England rate decision might be a little bit complicated, with the UK expecting the plan to curb inflation by up to 5 percentage points?
Yeah, I don't really.
September 15th, put that in the diary for the Bank of England's next big call. The ECB's just around the corner. We'll catch up with Luke Cower of UBS. Looking forward to doing that in just a moment. Futures positive, about 0.1% on the S&P. On the Nasdaq, we're up about 0.1%.
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable, it's transparent, it's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
Also with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. For our audience worldwide on TV and radio, this is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The Fed have laid out their course. They're going to be hawkish. They're going to continue doing what they're doing.
Dollar strength at the moment is helping the U.S. inflation story.
You're saying inflation in the United States still increasing. It's going to be a real problem until the Fed gets their arms around the demand side.
The Fed is very much committed to raising rates.
Eventually, the Fed usually does win out in the form of slower growth and eventually a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Stay tuned for a gripping couple of hours for global central banks. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures up about 0.1% on the S&P. In the next few hours, you'll hear from President Lagarde and Chairman Powell, Tom. That's just around the corner.
Well, Liz Truss just moved the pound. We had a nice rally in pound sterling off of the energy announcement by the new Prime Minister of the United Kingdom. You wonder what Lagarde will do in moving a euro at parity.
Well, Tom, Lagarde has got a lot of work to do herself. Can she move the euro with higher interest rates? Is it even about higher interest rates, Tom? Does that make a difference to this euro that's gripped by gas prices across the continent and what's going to happen with that economy into the winter?
Yeah, and within a war economy, and certainly the updates of Ukraine taking some square footage in Ukraine this morning shows the back and forth here of the war, John. I mean, she's got to address the war and the uncertainty forward, which is going to be number one.
What do they say in markets, Lisa? You buy the rumor, you sell the news?
Yeah.
When it comes to sterling, you sell the rumor, you buy the news?
I don't know.
Story?
You know, right now I'm looking at the pound and it's up 0.1%, and I could just wonder how staying this is going to be and what people are trading on, how liquid this market is at a time when you've called it, or other people have called it, I don't want to throw you under the bus, an emerging markets currency, or trading like one, given all of the volatility behind the scenes. Right now, what we're looking at is a market being dictated by something other than central banks, and central banks or bankers scrambling to try to give some sort of sufficient response.
Are they going to keep on hiking, potentially into recession in places like the UK and particularly in Europe as well? Can they keep on doing that, Lisa? I think we've all been surprised by the scale, the magnitude, not just of the fiscal intervention from the UK this morning, which is humongous, but also by the ECB. The fact we're talking about 75 basis points from the ECB is something we were not discussing at all even a month ago.
This can't be overstated. We were talking not so long ago about $17.7 trillion worth of negative yielding bonds, of bonds that yielded less than zero. Now that number has dropped to about $2 trillion. That is in Japan. In Europe, you are looking at the possibility of a 0.75% interest rate after today's meeting. How much does that change the absolute scale of what we're talking about with borrowing, with economic volumes, at a time when you're also facing a lot of constraints with respect to energy prices?
You mentioned Japan. The headline from Japanese authorities this morning, Tom, these FX moves are clearly excessive. That's their take. Bit of verbal intervention early this morning.
I've seen it before, and as I mentioned earlier, John, to me, it's just a question of this experiment they have, which devolves down to who owns the bonds. And the answer is they're co-opting the bond ownership in Japan. John, help us here with the translation. In the United Kingdom, the Prime Minister ending moratorium on shale gas extraction. As you know, John, the Chancellor of the Exchequer has been really overt about North Sea oil. John, what does it say? And it folds into Lagarde today about shale, about coal, about uranium, about a new ESGE given the cards dealt.
Well, it plays into a question you've asked, Tom, a million times. Is ESG dead? Is this the new reality of the energy story in Europe and beyond?
I mean, how does Labour respond to this? And how does Labour across Europe respond? How do they respond to what Lagarde says here in 2 hours?
Liz Truss saying this: we want to make the UK a net energy exporter by 2040. Lisa, that's going to take a lot of investment, and for that reason, that's why they say they're against, at the moment, a so-called windfall tax.
Right, but how do they guard this investment? How do they push it in certain directions that they want to see? And there are a lot of questions here that remain to be seen, and how this sort of justifies a fiscal backdrop that counts on some sort of energy independence by 2040. I don't know. It's a really tricky one to sell.
It's a tough spot for any policymaker right now. Live from New York this morning. Good morning. If you're just tuning in, we'll hear from Chairman Powell and President Lagarde a little bit later. Lisa's going to give you the times in just a moment. Separately, Tom, and we're going to have to work out on Bloomberg TV and radio which one we bring to you at what time. Futures on the S&P up 0.2%. On the Nasdaq 100 up 0.2%. Also, yields coming in a couple of basis points, 324.65. Gas is down in Europe. That's some good news for you. Crude has been lower in the last 24 hours as well, though it bounces back just a little bit right now, Lisa. 82.50 on WTI, up 6 or 0.7%.
I would argue that if we wanted to take one of them, we should take Christine Lagarde, because I argue that this is actually the more important news conference, the more important statement at a time when the Eurozone is facing a much more severe crisis in many ways than the United States. Today, we do get the ECB rate decision at 8:15 a.m. and Christine Lagarde, the head of the ECB, speaking at 8:45 a.m., which does conflict, as we're about to talk about, with Fed Chair Jay Powell, who's going to be commenting. The euro has been deteriorating. What kind of rate hike will actually support the currency? And that is something that we've been asking for months, and we might get some sense of that today. 9:10 a.m., Fed Chair Jay Powell participating in a moderated discussion at the Cato Institute. Yes, it is awkward timing, especially because there is a question about how much the Federal Reserve sees itself as central banker to the world. There actually are a pair of papers being released at the same time from Brookings, from different independent academics, saying that the Federal Reserve is not adequately accounting for how much pain needs to be suffered around the world in order to get inflation lower, given the dominance of the dollar, given how high rates are expected to go and possibly may have to go even further. Other Fed speakers today include Chicago Fed President Charlie Evans and Minneapolis Fed President Neil Kashkari. And at 2 p.m., we hear from someone who we have not heard from for quite a while. U.S. Treasury Secretary Janet Yellen. She's giving a speech on some of the green policies of President Biden, the latest fiscal spending package. She's going to be in Detroit. But this goes to this question, John. Is ESG dead? If we have Treasury Secretary Janet Yellen trying to push this, and we do have some financing for it in the United States, how does that conflict with the reality on the ground that's very much prioritizing some of the older, unclean energy sources like coal and like a lot of the fossil fuels?
Looking forward to it. We need to hear from the Treasury Secretary coming up a little bit later. Joining us now is Luke Cower, Director of Investment Solutions at UBS Asset Management. Luke, I'll ask the question a lot of people ask, and good to see you, mate, as always. When did the rate cuts start?
Well, in our view, that's still the kind of the trade to be fading. And I mean, there's still going to be a degree of stickiness in all of the cut odds at some point, just because if you run any back tests, it's going to tell you after the, Fed hikes this much, this fast, then, we're returning to cuts next year. I think in all of the rate volatility we've had this year, one thing that's been consistently underestimated is the sturdiness of the U.S. consumer, the sturdiness of the U.S. labor market. So that combined with a Fed that's not going to be too quick to kind of throw in the towel on declaring victory on inflation, I think that's a a recipe for trying to think of a tactical investment environment without needing rate cuts to support the case of any of your positions. That's, one of a higher conviction call of ours right now is that, that's something that you shouldn't see more and more priced in. We price them out a lot. Is there kind of room to go? Maybe, but that's going to be more of a kind of decay in pricing, getting rid of the rest of the cut odds. And that's going to be, every month, the U.S. labor market showing you that, hey, it's taken a bit of a licking, still kicking.
So it's a potato, not a lobster. Is that your take, Luke?
Yes. No, I just, kind of a joke here, just looking at, something someone told me about the lobster's thrown in a pot of boiling water, it dies. The potato, it's softened, and the Fed thinks by putting the U.S. economy into this boiling water of rate hikes, it's killing it, but really it's just preparing it, making it very nice for us to eat like a good mashed potato. The ramifications for the rest of the world in terms of dollar strength and what Lisa was kind of alluding to in papers that are going to be released. Yes, this is a tightening of financial conditions for the world over, more so than is being delivered to the U.S. economy. And one thing I think we've learned this cycle that's different from 2019 is that once you start caring about inflation expectations, then the luxury of being a central banker to the world, it disappears.
Luke, I miss you. Your food shots on Twitter and some of your culinary-minded analogies are fabulous. I am wondering what this means for allocations. I know you are neutral on equities in the U.S. What does that mean? And is the rest of the world, for the most part, uninvestable?
Certainly not, but I would say that kind of as you look across the spectrum and kind of staying neutral at the asset class level for us, that's the duck floating on water under the surface. Our legs are kicking a lot to try and find some trades with convex profiles at the kind of at the relative value level within asset classes. Kind of one thing we still do think is that from the perspective of relative equities, there's a lot of defensive trades out there that still make sense. So even as you might be thinking, well, rate vol has peaked, that's traditionally going to be a good thing for financial assets. Well, it's tough to get too optimistic about earnings power in an environment where you're still expecting economic activity to slow. Is the rest of the world uninvestable? Certainly not. But if you look at a lot of the things that could quote unquote wreck risk assets, a lot of the different scenarios from a macro perspective, you'd be looking at a stronger dollar is something that upsets the apple cart in a lot of cases, whether that's just right. Good news is bad news type dynamic, whether that's an energy price shock, which is going to be more FX in terms of trade negative for countries ex-US, or whether it's a kind of swift descent into recession. So that's still something from a portfolio context that makes a lot of sense. And there's short USD exposures out there that are better expressed outside currency, we believe.
Luke Cower, the author of Cowernomics. Great to catch up, as always. UBS Asset Management's Luke Cower. Lisa, that's what I'm calling it, Cowernomics.
I'm going to call it Cower Cooking.
I think it's great. It's a great analogy. And every time we get a decent jobs report, that's what I'm kind of looking at, this idea that maybe Luke's right, that this labour market is more resilient than people thought it would be.
Well, and how much does this hinge on the fact that gasoline prices have gone down so dramatically in the United States by about a quarter from their peak? Right. How much are you looking at that supporting spending, and how much can that continue given what you are seeing with the Strategic Petroleum Reserve and what you're seeing overseas?
Yeah, and I think what's important with Luke Cower, and this goes to all of his analysis, he takes every single analysis at UBS back to when the Toronto Maple Leafs last won, which was 1967. The Dow is up 10.2% per year since 1967.
Is that what you were busy doing in the last 5 minutes?
Yeah, but I mean, I think it's a lot Luke Cower analysis back to when the Leafs last won 52 years ago.
You could be his intern, Tom.
52 years
That would work out well.
Yeah, it would work out well.
Tom Keene, Lisa Bramett and Jonathan Ferro. Futures up by 0.2%.
It's not a snooze fest.
The ECB, about an hour away. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In the UK, Liz Truss's government has announced a sweeping package of measures to contain spiraling energy bills. The goal is to ease an historic squeeze on the cost of living that's likely to define her premiership. Now, the program will cap the amount consumers pay for natural gas and electricity. It will cost the government billions of dollars. The European Central Bank is on the brink of a jumbo 3/4-point increase in interest rates today as it tries to take back control over record inflation. A majority of economists surveyed by Bloomberg predict that the ECB will take an unprecedented monetary tightening step. President Biden will host a video call today with allies on support for Ukraine. Now, among those taking part, the group of 7 leaders, along with leaders from the European Union and NATO. The call is taking place at a key moment in the war. Ukrainian forces have launched a counteroffensive against Russian troops. Meanwhile, Vladimir Putin meets with China's Xi Jinping next week. President Biden is holding back on a decision to scrap any Trump-era tariffs on China imports. Earlier this summer, the president had signed off on a new exclusion process for exemptions from tariffs on manufacturing materials imported from China. Bloomberg's learned the administration is studying ways to help businesses seeking relief. And Tesla's operations in China are back in full swing after a factory upgrade and lockdown slowed down production. The electric car maker delivered a near-record 77,000 Chinese-made vehicles in August. That's a sharp rebound from the 28,000 that were built in July. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts.
What do you think is the future of the U.S. dollar?
For the next 50 years, you are absolutely going to see a monetary revolution. But what you're going to see in the short to medium term is the strongest fiat currencies will hold on for much longer than we probably admit.
In more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top end venture is sort of 3x net of fees. You ideally you're hoping for more than that. You're hoping for 5x or more. You're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Marc Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? It is high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Dijon Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. Wall Street prepares for the latest read on inflation.
Things are moving. The news flow is extraordinary.
Will headline inflation continue to ease?
The totality of the data has been better than expected.
Very positive movement on inflation.
Instant reaction on Bloomberg surveillance.
This is a new era, and it is one of the most pressing concerns facing us.
And what it means for the Fed.
This inflation fever is breaking and economies keep softening.
They are on track, perhaps, for that soft landing.
Inflation in Focus, Tuesday on Bloomberg.
This guarantee, which includes a temporary suspension of green levies, means that from the 1st of October, a typical household will pay no more than £2,500 per year for each of the next 2 years while we get the energy market back on track.
Fiscal intervention from the British Prime Minister Liz Truss just moments ago. Live from New York City this morning. Good morning with Tom Keene and Lisa Rabbits. I'm Jonathan Ferro. Futures up by 1/10% on the S&P, on the Nasdaq up by just 0.05%. In just under a little less than an hour from now, we'll hear from the ECB, a rate decision. Then 30 minutes after that, we'll have a news conference with President Lagarde for you. Going into it, parity for euro dollar, almost totally unchanged, positive almost 0.1%. Luke Cowler of UBS on moments ago, referring to the labour market as a potato, not a lobster, something that does not die in the face of hot water and rate hikes, something that softens a little bit. Steve Englander of Standard Chartered, weighing in. It's a noodle, cooked carefully, and it's nice and tasty. Cooked too much and it falls apart.
Oh, look what you
there
have
you go.
started.
Look at the contribution
started.
from the South Side in America, Tom.
Fresh pasta or dry pasta?
We'll find out. Maybe Steve will follow up. There you go.
The way I cook, it's a Swanson TV dinner, hopefully defrosted before you. John, do they have TV dinners in the United Kingdom?
No, not the ones you've described to me.
Little
Do they have
aluminum-
microwave meals? Of course they do, Tom.
But
not,
TV
I've
dinner
not heard
has
of
a
your TV
certain
dinner before.
panache.
Sounds like the 70s, Tom.
Exactly,
Yeah.
or even the 60s.
Wrong decade.
As well. We'll do a sterling analysis here in a bit, but right now, time's a wasting. Will Kennedy joins us at Queen Victoria Street, of course, running all of our energy efforts as well. Will, the zeitgeist in America is that somehow this is going to get fixed, and one of the ideas is Norway to the rescue. And there's other Norways as well. Do you and our team have an optimism that Europe can cobble together an energy solution?
I think there's a real determination in Europe and the UK right now to put together a package of measures that just get us to April, get through this winter. This winter is going to be the really difficult time without Russian gas. Hopefully next winter there'll be more supplies. What does that look like? It looks like every drop of gas we can get across the Atlantic from the US. It looks like every drop of gas we can get out of Europe. And it looks like cushioning the blows, as we've been talking about in the UK, for consumers.
Right.
And it looks like making sure that the energy market has the liquidity it needs.
What's interesting here, Will, politically, is the Prime Minister mentions shale. The Chancellor of the Exchequer, newly minted, loves to dash up to Aberdeen and look out across the North Sea. Can the United Kingdom actually come to its own
I think that most people in the industry think that that impact will be marginal. Now, of course, there's been a lot of political cross currents here. I mean, a year ago we were in Glasgow and we were talking about the energy transition, and there's a lot of pressure on British politicians to stop development of our very mature oil and gas industry. Now that has changed, and I think there's a real will to get people drilling again. Will that drilling produce much more gas? That's doubtful, and it certainly won't in the short term. And then when we look at fracking, there's always been lots of excitement about fracking. There is gas in the northwest of England in particular, but it doesn't look like Texas. It's crowded. People live close together, and they don't want huge trucks full of sand and huge
drill rigs in their back gardens. And the other thing is, they don't own the royalty under the land. The Queen owns that. In the US, if someone finds gas where you live, you get some money. That's not true in the UK, and it makes the politics very, very different. So I think fracking will struggle to get off the ground.
Wait, John, does the Queen own the land under Shea Farrow in the Midlands?
No, that's ours, Tom.
Okay.
That's mine.
I just was lost there for a minute.
That's mine.
Continue.
She's not having that.
Continue.
Will Kennedy, the leader of the opposition, Sir Keir Starmer, saying this: the windfall tax is now the basic political divide. The Prime Minister this morning has unveiled a plan to cap prices. They'll cover the difference with the energy supplier. So this is uncapped liability, as you and the team have reported all week. Can you run me through what we heard this morning and why they are not keen on a so-called windfall tax?
I think it's a political, almost ideological thing, John. Clearly, Truss has come into office on a very a platform of very pro-business platform, a tax-cutting platform, and I think that the last thing she wants is to make her first policy a new tax. I think she's very opposed to it. So, you know, the argument is that they want the industry to have the capital to invest in renewables, to invest in fracking, to invest in the North Sea, but clearly it does open a dividing line about who's going to pay here, because at the moment it's the taxpayer who's going to pay for all of this, as you say.
Which raises the question of whether this headline on the Bloomberg terminal makes any sense on any kind of logical way. Not the headline, but the conclusion of it. UK says energy aid will cost Treasury billions and cut inflation. Is that a plausible outcome?
It probably is in the short term, because when people made their very apocalyptic forecasts, you know, I think Citibank said 18%, maybe Goldman said 22% about how high inflation could get in the UK over this winter. That was largely based on the idea that the energy price cap for households would be allowed to rise and rise and rise, and you might get households paying £5,000, even £6,000 a year. Now, by capping it at £2,500 for 2 years, that element of inflation is taken out of the equation. So there is a sense in which it will put a cap on inflation. Now, obviously, as you say, Lisa, there are longer-term dangers about what happens to the state of the British finance, what that means, British balance sheet, what that means for the pound. But I think in the short term, yes, one of the attractions of this policy is that it will have a positive impact on the inflation numbers.
Well, you framed that perfectly. Thank you, sir. Will Kennedy, out of London. Just perfect. Talking about how, on the one hand, it will reduce inflation because you're capping energy prices, reduce it relative to what we would have expected through much of next year, but also at the same time, it introduces a bit of risk, Tom, into the gilt market and to sterling as well.
Absolutely.
And sterling's been a channel through which we've imported inflation into the UK with a much weaker pound.
The deterioration in sterling is stunning. Folks, very quickly here, I don't want to get too mathy, John. The midpoint of the volatility study of sterling is a stunning 117.66-ish. That is miles away. Truss moved sterling this morning, John, but it's a blip compared to the deterioration we've seen.
Oh, the low yesterday, Tom, towards 114. Brutal. 114.06.
Yeah.
TK, I was joking yesterday that you were in the line for the new iPhone. Were you in the line for the new iPhone?
No, I didn't get the
when
old
does the
one.
line for the new iPhone start? Does that even happen anymore?
This is old. I didn't get the 13.
You didn't get the 13?
But John, they've made a watch for you finally. I mean, folks, you don't know this. I mean, Abramowitz is running 20 miles a day. John swims the Hudson River, and there's the new Ultra watch, finally, and I think Tim Colpin writes this up for Bloomberg brilliantly. John, a watch for you. It's priced like a Patek, but
how much
John,
is it?
It's like a Patek. I don't know, 15 grand, whatever.
A Patek's more like 40, isn't it, Tom?
I don't know. You can get an Hermes watch band with it, John. It just says you. I mean, I thought of you when I saw this.
I'm just not into those kind of watches, TK. They just don't do it for me.
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable. It's transparent. It's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
You can check
if anyone
what
wants to
time
send me a
it is
Patek,
when
I'll
you're
take a
swimming the
Patek.
Hudson.
From New York, this is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Binky Chandra of Deutsche Bank came out yesterday and said this: if you get a recession on the S&P, we'll see 3,000. If you don't get a recession, we might rally back to 4,750. Helpful, Binky.
That's
Need a
helpful.
chat.
Yeah,
Can we have a
that's
conversation, please? The difference between a recession and not a recession is 3K or 4,750.
Oh,
Looking forward to catching up with Binky Chandra in the next couple of weeks. Futures unchanged on the S&P 500. On the Nasdaq right now, basically unchanged as well. Into the bond market, you've heard the news from Goldman. They're on board with 75 for a decision from the Federal Reserve later this month. Your 2-year right now, 342.49. Basically unchanged there. Going into the ECB, the euro basically unchanged as well. Even with some verbal intervention from the Japanese authorities, dollar yen not doing a whole lot in their favor. Dollar yen right now, 143.54. Just the tiniest bit of Japanese yen strength. And we're all looking at sterling at 115.35. Yesterday, the low of the session, 114.06. That took out the pandemic lows for cable. The weakest currency, the weakest sterling we've seen against the US dollar, Tom, going all the way back to the mid-80s.
Right.
And what we heard from the Prime Minister, Liz Truss, in the last hour, Tom, to cap energy bills, the exact price of this plan is hard to say because it all depends on where gas prices will be. But it could be, Tom, 200 billion plus over the next 2 years. We'll see.
John, I think this is so great. I'm so glad we had this moment with you. A former prime minister speaking from behind the bench to the new prime minister. John, I believe I have to go back to John Quincy Adams for an American equivalent. John, explain this. This is, to Americans, this is as foreign as it gets.
Well, Tom, you're an MP first. And if your party has a majority in Parliament and you're the leader of that party, you're the Prime Minister. She was the leader of the party with a majority, but she's still an MP.
Right.
And that's the story. So she's a member of Parliament. She's still in there. She's asking questions, interventions, asking questions of this Prime Minister. That's just the system, Tom. It's how it works.
And they're not building a Prime Minister's library for Theresa May, are they?
No, Tom. No, she's not got a big foundation with tons and tons of money pouring in and doing great stuff.
I editorialized. Continue, John. I didn't mean to interrupt, but I just thought that was a great
I'm sure
moment.
you did not mean to interrupt.
Yeah, I never did.
What's going on today, guys?
That's the cross-asset price action. Let's get you some single names. We can do that with Lisa this morning. Hey, Lisa.
Hey, how's it going? I'm keeping my eye on retailers today because we are getting the last drips and drabs of this earnings season. Yesterday, we got American Eagle coming out with disappointing second quarter earnings, actually pausing their cash quarterly dividend. Those shares down almost 15% ahead of the open. And Wayfair, also a retailer, seeing its shares decline nearly 10% in pre-market trading after selling a $600 million of convertible debt. So some concerns about dilution. One stalwart is GameStop. This story is never ceaselessly fascinating. 7.5% gain ahead of the market open, not because the earnings were so great. They weren't. They were actually particularly soggy, but it was a partnership with FTX that really got a lot of people's attention, and because of the passionate stockholder base or something like that, which was what some of the executives of GameStop called it. Elsewhere, we're looking at some of the pandemic darlings that have seen rather soggy post-pandemic fortunes. DocuSign among them. Those shares did lower by about 0.25%. They report earnings after the bell today. Question that a lot of people have is how low can they possibly go, considering the fact that they've already declined about 60% so far this year, 80% over the past 12 months. So have we already priced in everything possibly that could get thrown at them? And I think that the bar has been set at so low that perhaps some people are getting a little optimistic, maybe. Roku shares popping just a touch up 0.9% as they are upgraded by Pivotal Research on the potential for a more robust outlook. And Apple shares are lower by 0.2%. Hard to call this a mover, but interesting to see that the shares popped yesterday after the release of the new iPhone, especially because they paused price hikes. They actually are offering it at the same price despite some of the inflation going forward. This is a really interesting nod, Tom, to the competitive landscape as well as the deteriorating willingness of consumers to just absorb everything.
Just getting some headlines, Lisa, on the Queen. The UK's Queen Elizabeth to remain under medical supervision. According to these headlines, doctors are concerned for her health. Tom, those headlines just dropping moments ago. That's all we have so far, that the Queen is to remain under medical supervision and that doctors are concerned for her health. Any updates? And I'll bring them to you.
And a photo of a fragile Queen with the new Prime Minister here in the last 48 hours as well. Right now we move forward to the call of the summer, which was out of TD Securities, and that would be Priya Misra. The dovetail of that is maybe the call of the last 12 months, indeed 24 months, which is her colleague Mark McCormick. His resilient dollar call was absolutely brilliant in hindsight. He joins us this morning. Mark, are you still resilient dollar?
Yeah, we still like the dollar short term. We upgraded our forecast. We're looking at DXY probably test about 112, so it's about 3% from here. I think there's going to be some split, whether it's we look at the Japanese yen relative to European currencies, but right now, most of the shock is going to come through euro and sterling.
I love your cross-rate analysis. You've got some odd ideas, which are great. Taiwan against Korea. You've got Swiss franc against Japan, and that. Is it a point where we can't look at the more comfortable pairs we look at normally, and we have to go to other currency pairs?
Yeah, it's a great question, because what's interesting is that all the things that are happening around the world are kind of driving different factors to make different countries more valuable than others. So in that context, the number one thing that's still driving everything is terms of trade. So the energy shock. So it's more important that we look at oil prices for Japan, and it's more important that we look at the electricity and the energy and the natural gas markets in Europe. And so the terms of trade are diverging, which should be beneficial for the yen over time, but it's still kind of a drag for the European currencies. When we look at Asia, what we're seeing is financial conditions are easing through China, but they're tightening in Europe and they're slightly tightening in the US. So there's a massive gap between Asia, the Americas, and Europe. So what we're seeing is there could be scope here for Asian currencies to start to recover in the months ahead, even though we think dollar China should touch 710, because we're starting to see equity flows come back. So there's a really complicated mix of valuations, relative equity divergence, terms of trade shock, and all these things are creating gyrations across all different currencies.
I want to sit on a point that I think you're making just a little bit longer, that perhaps the energy prices are more important to the outlook for currencies than rate calls by central banks around the world. And this is something that we've been talking about quite steadily. So what are you looking for tomorrow from the energy finance ministers in Europe who are going to be meeting? What kind of plan could give you some confidence that we've seen the bottoms for the euro?
So I don't think there's a lot we can get in the short term. I think where we've wrapped our head around this is, like, if you look at people are looking at the relative stocks of what's going on in the natural gas sector. And I think what's the problem is we need to watch the flow. So if we look at the stock levels are at 80, 90% and people get confident about it. But what we need to look at is the daily flow, the changes in the flow, because what we have right now is even at 80, 90%, that's only good enough for 75% of 1 month in the winter. And now all of us are forecasting the weather. So I think the stimulus and the packages and all the things that are being put in place, price caps, rationing, they're good for a longer term story for the euro. Next year, we're generally pretty bullish. We don't think this is a full long structural dollar cycle, but we're still kind of driven by these terms of trade shock. So I think what we're getting is confidence that things can recover next year. But we still need to get through the end of the Fed tightening cycle. We still need confirmation that inflation has peaked. We still need to know where terminal rate pricing lands, and we still need the global economy start to recover. So in the context of what we are expecting from the energy side, is fiscal stimulus is good, but in the short term, more demand and less supply on the energy markets is still going to prop up inflation. So real rates are still going to continue to move against euro and sterling for the next 3 to 5 months until I'd say Q1 of next year.
So until we get more certainty, how much liquidity is there in some of these very deep FX markets that traditionally have been very much the tell for so many other markets?
Well, I still think there's a lot of depth and complexity that's going through. Volumes are pretty high on some of the standard G10 currencies. Is probably where you lose some interest is when you look at Norway and Sweden and some of the Scandinavian markets. They are trading very much like, or even worse than, emerging markets. Like if you look at something like the Mexican peso, the Brazilian real, they're trading off relatively important, strong fundamentals that are an interesting backdrop. Because if you would think the environment that we're in now, which is U.S. equities are outperforming, real rates in the U.S. have rocketed, especially at the 2-year level. And if we look at how Mexican peso is traded, it's trading as an interesting dynamic where global data set prices are improving. People are starting to become more interested in carry. That's a question that we keep getting a lot. Like, when should we move back into emerging market carry? And the peso kind of captures that sweet spot. So the traditional currencies that people are watching are still kind of doing what they should. But it's really some of the, I would say the periphery ones, like the Norwegian krone and Sweden. Those currencies are almost impossible to trade right now.
And Mark, just quickly, just to really tighten it up, if we get 50 and not 75 from this ECB, what does the euro do?
Right, so we're anticipating actually 50, and we think it's basically a coin toss. But the sequence is this: what's the terminal rate? We're expecting the ECB end at 2. So do you go 50, 50, 50 from here, or do you go 75, 50, and 25? We're expecting they go 50 now and try to maintain the same level of getting to a terminal rate of 2. Yeah. Euro is absolutely not going to like that, and so what we're anticipating is we're getting a little bit of a short squeeze here. Fade the euro, and we are looking for a move over the next couple of months to 96 cents.
Mark McCormick, thank you, sir, of TD Securities. Laying it out for you with a bit of crystal ball type stuff. Looking out to next year. We'll hear from the ECB at 8:15 Eastern Time. We had a statement from Buckingham Palace just moments ago. I want to share that statement with you from the Palace. Following further evaluation this morning, the Queen's doctors are concerned for Her Majesty's health and have recommended that she remain under medical supervision. The Queen remains comfortable and at Balmoral. Balmoral, for those of you that don't know, the Scottish holiday home to the royal family. That statement follows news in the last 12 hours or so that the Queen had to postpone a meeting with senior government officials just yesterday, Tom, after a full day of activities with Boris Johnson visiting her and then, of course, Liz Truss. So, TK, that's the latest from the Palace this morning. That statement coming just moments ago.
A path on from 1953, and we'll have to watch it very, very carefully. No question about that.
Looking forward to catching up with Guy Johnson, I believe, in about 3 minutes or so, 5 minutes or so from London. And we'll get you all an update on the Queen's health from the UK. At the moment, futures unchanged on the S&P 500, on the Nasdaq 100 down about 0.1%. Yields down 5 basis points on a 10-year, 321.42. In around about 34 minutes' time, you'll hear from the ECB. It's a toss-up, a coin toss between 50 basis points and 75. We'll see how big that rate hike is. Then 30 minutes after that, you'll hear from President Lagarde herself in a news conference. And about halfway through the news conference, at some point, you'll hear from Chairman Powell. So a busy couple of hours coming up on Bloomberg TV and on Bloomberg Radio. Futures unchanged, live from New York. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's new Prime Minister says there are no cost-free options to resolve the global energy crisis. Today, Liz Truss unveiled a sweeping package of measures to contain spiraling energy bills. It will cap the amount that consumers pay for natural gas and electricity. By one estimate, that could cost the government up to $230 billion. But officials say it will cut inflation by 4 to 5 percentage points. If economists surveyed by Bloomberg are correct, the ECB will join more than 40 central banks that are using outsized rate hikes to fight inflation. The ECB is expected today to raise rates by an unprecedented 0.75 percentage point. The rate decision is due at 8:15 New York time. ECB President Christine Lagarde will speak afterwards. U.S. Secretary of State Antony Blinken has made an unannounced trip to Ukraine. Blinken arrived in Kyiv today for meetings with Ukrainian officials. It's his third trip there since the war with Russia began in February. The Pentagon has sent Ukraine its most accurate artillery shell. That's according to budget documents that show the U.S. military is spending $92 million to replenish its stock. The Excalibur is a satellite-guided projectile that can hit within 7 feet of its target. Each round costs roughly $100,000. And there was just one major surprise at Apple's latest product unveiling. In one of the worst years of inflation in decades, well, the company is not raising prices. Apple introduced the new iPhone 14, new AirPods Pro earbuds, and new Apple Watch. The iPhone looks similar to the older version while getting an improved camera and also a satellite messaging feature. Global News 24 hours.
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable. It's transparent. It's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
Today on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg Terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
update on the Queen's health from Buckingham Palace just moments ago. Here's the statement for you. Following further evaluation this morning, the Queen's doctors are concerned for Her Majesty's health and have recommended she remain under medical supervision. The Queen remains comfortable and at Balmoral. Balmoral, of course, the Scottish holiday home of the royal family. Already getting response from the British Prime Minister Liz Truss, who had this to say out on Twitter just moments ago. The whole country will be deeply concerned by the news from Buckingham Palace this lunchtime. My thoughts and the thoughts of the people across our United Kingdom are with Her Majesty the Queen, Tom, and her family at this time.
And we begin, after the photo yesterday, or 2 days ago, John, that we saw of the Queen greeting the Prime Minister, of course, also the former Prime Minister Johnson. John, your thoughts on that photo?
I think a lot of people saw that photo, Tom, and thought that the Queen looked frail at 96 years old, perhaps unsurprising. Guy Johnson has the latest for us from London. Guy, walk me through how rare it is to get an update of this kind from the palace.
Extremely rare, John, and quite candid in some ways. Normally, the language used around the Queen's health is a little bit more opaque. I think this is, relative to what we would normally get, quite clear. They are concerned for her health. I think that should speak to exactly the situation that we find ourselves with here. The Queen has decided to stay at Balmoral over the last few weeks. Normally, she would have greeted Liz Truss and asked her to form a new government at Buckingham Palace. First time it's ever happened. That didn't happen. She's postponed a Privy Council meeting of senior ministers. She is clearly trying to, and her doctors are making this clear, that this is what she needs to do to rest. And I think that's all we can say at this point. But John, to your point, I think this is a very candid comment from the doctors that look after her, the very good doctors that look after her. The medical care is second to none.
Guy, help our worldwide audience, including Morning in America, with how Prince Charles will respond to this news. Obviously, a family. He was at her coronation as a very, very young child. But how does Prince Charles, the Prince of Wales, respond to this news?
Tom, I remember you asking me exactly the same question when Prince Philip died last year. And I think probably the same answer holds true, and that is that this is his mother. They are very close. And as a result of which, I think that will be his first response. This is his mother. He will be devastated that she is as frail as she is. They have had a close working, personal, family relationship, and they are very, very close. So obviously, I think that will be his first response. Clearly, he will understand that he has a responsibility to the nation, and that is where I think the response this time round differs, Tom. This is the crown. This is the Queen. This is him taking over that crown and becoming king. And I think he will understand the weight of that and understand the responsibility that comes with it. So therefore, I think it is a different response. But I think primarily, first of all, this is his mother, but it is the crown. It is the Queen. He will become king. And therefore, I think the response is very different from Prince Charles this time round.
Guy, just to put this into perspective, Queen Elizabeth II has been queen since she was 25 years old. She is now 96 years old. She has invited Winston Churchill to be prime minister and just invited Liz Truss to be prime minister. This is someone who spans an entire history and many histories, people could argue, within the United Kingdom. Can you put into perspective, especially given her popularity, what this means for a nation that has seen her as a leader through so many generations?
Most people won't remember anything else. And as a result of which, Lisa, this is a huge wrench for the country. It is a massive wrench for the country. She has been totemic. She has been front and centre. She has been at the core of British life for so long that this will be a huge wrench. She has lived through and been monarch through a huge transformation in the UK status in the world. Coming out of the Second World War, through Suez, through the turbulence of the 70s, the 60s and the 70s. She has been steadfast through all of that. She has been the rock on which the British system has been founded. And removing that keystone is huge and will have a huge and profound effect on the way that Britain thinks about itself going forward. She has been central. She has been absolutely at the core of everything. And to remove her from that position, I think, will be a major, major change for the United Kingdom.
Guy, this is quite rightly going to dominate the news flow in the United Kingdom for the very least the next 24 hours and beyond if things develop. Guy, is anyone going to be talking about what we heard from the Prime Minister in the last hour?
That's an interesting question, John. I think the cost of living squeeze this winter is going to be very difficult for the UK. And as a result of which, in some ways, the timing is not good. The UK has many challenges ahead. I think people will be relieved that Liz Truss has got this information out before this subsequent news surrounding the Queen has developed. And as a result of which, I think a lot of people in the UK will be breathing a sigh of relief that their energy bills will be limited throughout this winter and maybe into next as well. So in some ways, the sequencing, allowing that news to come out, I think is important. A lot of people will take that as a sigh of relief. But as you say, and I think as you allude to, John, I think a lot of people's attention will now refocus on what is happening at Balmoral.
Guy, thank you, sir. We'll catch up with you a little bit later. Bloomberg's Guy Johnson there on the latest. If you're just tuning in on Bloomberg TV and radio, this was the statement from the palace we got in the last 20 minutes or so. Following further evaluation this morning, the Queen's doctors are concerned for Her Majesty's health and have recommended she remain under medical supervision. The Queen remains comfortable and at Balmoral. Balmoral, of course, the family home, the Scottish holiday home to the royal family. Liz Truss, who just 2 days ago invited to form a government by the Queen. Liz Truss had this to say: the whole country will be deeply concerned by the news from Buckingham Palace this lunchtime. My thoughts and the thoughts of people across our United Kingdom are with Her Majesty the Queen and her family at this time. As for her family, Tom, according to the latest reports in the UK at the moment, I understand Prince Charles and Camilla are at Balmoral to be with the Queen's side, and Prince William is travelling up to Scotland as well.
There'll be a lot of coverage on this, and I think the tradition, not that I'm an expert on this, John, but the tradition of the family, the House of Windsor, of being in Scotland speaks volumes. This goes far back to the Queen's mother, and I would just suggest the comfort there versus the drafty halls of Buckingham Palace has to be tantamount.
We'll stay on top of the news flow for you. Any updates, and we'll bring them to you. We need to gear up for an important couple of hours for financial markets, of course, and that's where the focus is going to be on this programme into the next hour with an ECB rate decision about 20 minutes away. Then after that, you'll hear from the chairman of the Federal Reserve, Jay Powell. He's going to have his own address a little bit later, at the same time that President Lagarde is delivering a news conference. So, Tom, here's the plan as far as I'm concerned on TV and radio. We get that decision at 8:15 Eastern Time. 30 minutes after that, we'll have a news conference with President Lagarde of the ECB. We'll carry that through the news conference until we hear from Chairman Powell, and then we'll pick up on Chairman Powell's comments, Tom, once they commence.
I have been at the Cato Institute where the chairman shows up, John, and it's always interesting. It is a different think tank. There should be some comments that are important.
And that's where the focus will be, with futures unchanged on the S&P 500, on the Nasdaq 100, down around about 0.1%. Live from New York City this morning, good morning to you all with Tom Keene and Lisa Bramberts. I'm Jonathan Ferro. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak with Lee.
Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I think what's going on right now in Europe, frankly, is confusing.
Globally, you can see economies all around the world are slowing down.
The U.S. economy is in a much better spot. No, it's not a great spot, but it's in a much better spot than Europe.
The dollar is ending up as the safe haven of choice by default because there's all these issues in the rest of the world.
With the momentum here and what's going on in Europe, we're going to see the 75 basis point probably tightening from the ECB.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. An extraordinarily busy day with an ECB decision in 15 minutes. The Queen's illness noted in Scotland. But, John, now we focus on Christine Lagarde, 50 basis points or 75 basis points.
50 or 75, and Tom, if it's 50, if it's 75, we're still going to ask the same question. They're facing down the potential, the real potential of going into recession. Can they keep hiking into that TK when a lot of this comes down to the price of gas?
And they are not, John, one cohesive Brussels or one cohesive Frankfurt. There's a fractured Europe at the moment here. Which country are you going to follow most here as we see the press conference and the nuances of it?
So actually for me, Tom, it's within the executive board in Frankfurt. It's a split. It looks like a split between Philip Lane, the chief economist on the executive board, and Isabel Schnabel. Schnabel seems to be very, very keen on front-loading, going hard and being decisive. Philip Lane has taken a little bit more of a delicate approach in his recent communication, Tom. So I wonder how that debate takes shape in this news conference when President Lagarde has to try and represent some form of consensus on the committee.
And the consensus there goes back to the heritage of the ECB, John. I go back to Otmar Issing and all that I've done with him over the years, and of course Trichet of France with a different approach as well. Schnabel's a name many of our listeners and viewers don't know. She was a force at Jackson Hole.
By far one of the best communicators at the European Central Bank, Tom. By far, and we can all agree on that. The difference between this ECB and the ECB under Draghi is that the Bundesbank, Tom, is at the wheel. The Hawks are in charge on this one, and that's been a major change under Lagarde, particularly in the last couple of months. And let's face it, it's been a big change because inflation has seen a massive change in Europe over the last year.
And Lisa Bramlett's in charge as well as the price of this currency or that. And then there's the currency of this war, which is hydrocarbons, West Texas Intermediate nearing $79 a barrel.
The push-pull of demand destruction with supply destruction, with this idea that not only are you getting some constraints from the war that Russia has waged in Ukraine, but also with the idea that OPEC Plus marginally reduced some of their supply targets in response to the demand destruction, which takes center stage. And how do you achieve demand destruction if you're supporting the household expenses that have to do with energy, like a lot of European nations are trying to do?
Finally, Dollar takes a break. John, let's get to the data check here so we can get to Alessio De Longus as we go 12 minutes to this ECB decision. John, there, Maria Tadeo in Frankfurt as well, I believe, in this hour. John, I'm going to go to Brent crude 88.41, distant from the 120 panic of weeks ago.
I love Maria. She takes a month off and comes back for the ECB rate decision.
I took a sabbatical too,
Only
John,
returns for the
yesterday.
news. You want to take a month off on futures?
No, I took a day off. Leave me
Unchanged
alone.
on the S&P 500. On the NASDAQ 100, we're unchanged too. Leave you alone. You're the vacation police, not me. Euro dollar, unchanged, basically at parity, up about 0.1% on that currency pair. TK yields lower 4 or 5 basis points. 321.80, big turnaround in crude yesterday. Bouncing back just a little bit, up 0.6%. WTI, 82.46.
To give you perspective on this important decision, we're thrilled. Scheduled Holger Schmieding will join us from Berenberg, and we wanted to get somebody just as astute before this announcement. Alessio De Longus joins us, Senior Portfolio Manager, Head of GTAA Solutions. He does that at Invesco. What will you look for? What is the nuance of the 8:15 announcements, not the press conference, but the series of Bloomberg headlines that come out?
Well, in my opinion, it's really the headline itself. It's really all about that 75 versus 50.
Nothing else really matters. It's just a single.
Yes, because I think we are in a position where the ECB really has to keep up with the pace of tightening that is happening elsewhere, with the Bank of England, with the Fed, because ultimately, and we already started talking about it, it now becomes a currency war game potentially going the other way. If the ECB does not deliver 75, the weakness in the euro versus the dollar or other currencies will actually negate any policy tightening efforts, because a weakening euro, true, euro dollar does not matter as much to the ECB, but it does matter when your problem is inflation on the energy front, which is priced in dollars, right? So the ECB needs to deliver 75 basis points to stay on par with the hawkish rhetoric of the Fed and the Bank of England. That's, I think, what really matters. And to your earlier discussion with John, I think that there is actually an opportunity here for the doves to concede, because at the moment, with where inflation is, there is really no argument to be had. But the doves may have the upper end again, say, 2 quarters from now, when further hikes are far more challenging, when growth will be weaker.
Well, Alessio, let's talk about the forecasts. We should get in the news conference from President Lagarde. Is this central bank prepared, do you think, to forecast a recession?
Great question. I think they'll probably shy away of a negative GDP growth in 2023, but it will be very close to zero, maybe south of 0.5%. What I think they will do, though, is show that even out in 2024, both headline and core will be at 2 or above 2, which is already a big concession, in my opinion. I think that's the most important metric at the moment.
So right now we're looking at what you were talking about with respect to the doves possibly taking a little bit more control in a couple of quarters. Does that make you potentially bullish on certain European assets down the line, because you could see that pivot first by the ECB?
The timing on that is very, very particular. We are at that inflection point, and it may be a matter of a couple of quarters or a year. But we are now at those extreme valuations relative to U.S. assets on basically every asset class. Obviously, let's not get started on relative equity performance, but even when you look at rate differentials on the short and the long end, very extreme spreads. And on the euro, the conditions for the euro to continue weakening here are in place, even with the 75 basis points, regardless of what will happen today. We have those two forces that are supporting the dollar. Global growth disappointing, below consensus, that's dollar positive. And yield differentials, both on a rate of change basis and the level, support the dollar in an incredible way. But that pivot, when we are at the very last steps of these tightening cycles, that pivot will be very, very powerful. The next recovery, which could be just less than a year away, will be led by non-U.S. assets, will be led by the euro, in my opinion.
This is fascinating, especially because right now people are piling into the dollar, as you just said, and continue to move away from all non-U.S. assets. So how violent will this shift be, and what will the catalyst be? How do you get ahead of it at a time where it's really hard to predict what Vladimir Putin's going to do, what prices of oil are going to do, or anything else with Chinese lockdowns, et cetera?
Well, we know that currency valuations in particular can really overshoot and undershoot fundamentals. And I don't want to draw a direct analogy with the Plaza Accord of 1985, but we are potentially in one of those situations where the momentum in favor of the dollar, because there is no alternative, because of the geopolitical risk, becomes so strong that some form of intervention, some form of coordinated intervention will have to take place. By the way, that happened also in 2000, 99, 2000, 2001, when the dollar was at incredible strength. And we had this similar rotation, this dominance from U.S. assets into the following phase, which was non-U.S. assets led. So I think some level of policy coordination will have to take place if we continue with this trend.
Alessio, I struggle with this. And I'm not here to say whether it happens or not, just to say that I struggle with it because the Treasury, this Fed, this country right now needs a strong currency. And if Japan wants one, then they can do something about it themselves, can't they? Tomorrow.
True. Every country, this is the paradox compared to 10 years ago, that now currency wars are actually in reverse, where everybody needs a bit of a stronger currency to deal with the inflation problem. The challenge, yes, Japan typically has intervened. The challenge is that it's very frowned upon. There is this agreement, this gentleman's agreement that meaningful currency interventions have to be coordinated and have to be discussed, because we don't want to go back to that environment in 2010, 2013, where we were doing competitive devaluations. In this case, we would be doing competitive appreciations of those currencies.
Alessio, wonderful to catch up. We can't squeeze in Napoli. We'll have to do that another time. But I know you're excited, and I was happy too. Alessio De Longis there of Invesco. Tom, any policy decision involves a trade-off. And Japan has decided right now that it's more important, the BOJ has at least, to maintain a cap in its bond market in JGPs. The consequence of that at the moment, quite clearly, is a much, much weaker currency. If they believe the trade-off is not worth the squeeze, then tomorrow morning they can do something about it. If they remove the cap and the BOJ did that, Tom, what do you think would happen to JGBs?
Jump condition.
What would happen to the Japanese yen almost immediately?
Immediately.
Now, if you're the US policymaker, if you're in the Treasury right now and you hear Japan complaining about the currency being too weak, what are you going to do? Don't you just call them back and just say, well, we're doing what we're doing, and you can do something about it if you want to.
We've done this for years. John, I think to set this up for people, there's nominal GDP, what actually is earned, and then you take away the inflation component, and you have real GDP or inflation-adjusted GDP. Each culture and society worries about one or three of those. The weightings vary, and it's a collegial debate that's out there. Japan is fixated on constructing an inflation, of avoiding deflation, and they do that at the expense of nominal GDP, and the answer is it's a zombie economy. There's no other way.
And at the expense of a weaker currency, seemingly, as well, Lisa.
Well, that's the reason why the currency really hasn't responded to the verbal intervention, right? I mean, maybe marginally on the edges, but people say if you want to do something, you very well can, and this isn't going to work. We're not going to blink because you just say, we don't like it.
In the last currency war, and it was currency war in reverse, remember, it's different to what we've got right now. I remember the authorities in New Zealand talked about turning up to a war with a pea shooter. And I think we've got to face the fact that the Bank of Japan has its own bazooka. It's just using it to do something different to everybody else. And the outcome is a weaker currency. Got an ECB rate decision about 4 minutes away. We'll break that down for you from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. If economists surveyed by Bloomberg are correct, the ECB will join more than 40 central banks that are using outsized rate hikes to fight inflation. The ECB is expected to raise rates today by an unprecedented 0.75 percentage point. The rate decision is due in a few minutes from now. ECB President Christine Lagarde will speak afterwards. The UK's new Prime Minister says there are no cost-free options to resolve the global energy crisis. Today, Liz Truss unveiled a sweeping package of measures to contain spiraling out energy bills. It will cap the amount that consumers pay for natural gas and electricity. By one estimate, that could cost the government up to $230 billion. But officials say it will cut inflation by 4 to 5 percentage points. Meanwhile, doctors for Queen Elizabeth II say they are concerned for her health. A statement from Buckingham Palace says the British monarch is comfortable at Balmoral in Scotland. Queen Elizabeth is 96 years old. She was seen earlier this week meeting with the new Prime Minister. And President Biden is holding back on a decision to scrap any Trump-era tariffs on China imports. Earlier this summer, the president had signed off on a new exclusion process for exemptions from tariffs on manufacturing materials imported from China. Bloomberg's learned the administration is studying ways to help businesses seeking relief. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Certainly when you look at Europe, the US is in a much better spot. As I say, not great on its own in absolute terms, but in relative terms, yes, it's hard to make a case for Europe over the US in any form right now.
That was Lee Farage State Street just yesterday going into an ECB rate decision. That decision is 1 minute away. With Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. Going into it, futures positive, about 0.1% on the S&P 500. On the Nasdaq 100, unchanged. Euro dollar, Tom, 1.0018.
Right.
We're positive about 0.1%.
Pro tip, follow John Farrell. The dynamic here that matters is to watch the outlier, which is Italy. It'll be interesting to see how Italy paper moves here.
And that spread going into this decision, about 227 basis points. Lisa, 50 or 75, we're 30 seconds away.
And whether or not it's going to matter, right? A lot of people saying the consensus is 75. You are seeing a bit of euro strengthening ahead of this. Can it stick regardless of what the ECB does in the face of some of these energy problems?
And Bramo, a news conference as well. Yeah. We're looking for some forecasts, and I think it's important to recognize this. We're all talking about a recession, aren't we? In Europe. It's not there yet. Might be in one now. Haven't seen the data yet. Will the ECB actually forecast one in that news conference in 30 minutes?
And if they don't, what does it mean for their credibility at a time when everybody else seems to be forecasting one?
Seconds away from that rate decision, we are looking for 75. Most people, though, think it's a coin toss between 50 basis points or 75 from this ECB. The decision moments away. Leaks out seconds late. This is not unusual. There it is, 75 basis points from the ECB. The depot rate goes from 0 to 75. The marginal lending facility goes to 150. The main refinancing rate goes to 125. So that is a 75 basis point hike from the European Central Bank. The reaction in the market looks like this on euro dollar. Slightly positive by 0.1%. Euro dollar right now, 1.0018. I was talking about the spread between Italy and Germany at the moment. That's about 2.27. So, Lisa, 50 or 75? It's 75.
And the question is going to be what they signal going forward, as a lot of people are already pricing in another 75 basis point of rate hikes through the remainder of the year. What does this mean for assets? You are seeing a bit of a pop, as you said, to the euro. But how much do they buffer this with some recognition of the pain that is being conferred on the euro region as a result of the higher energy prices, as well as suddenly the fact that negative yields, zero rates, has absolutely evaporated?
Working through the statement, we're getting some forecasts here. Looking ahead, the ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 2022, 5.5% in 2023, and 2.3% in 2024. On the growth outlook, after a rebound in the first half of 22, recent data point to a substantial slowdown in euro area economic growth, with the economy expected to stagnate later in the year and in the first quarter of 23. They go on to say, very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they're still constraining economic activity. In addition, the adverse geopolitical situation, especially Russia's unjustified aggression towards Ukraine, is weighing on the confidence of business and consumers. The outlook is reflected in the latest staff projections for economic growth, which have been revised down markedly for the remainder of the current year and throughout 23. I can give you that outlook now. They look for the economy to grow by 3.1% 0.1% in 2022, 0.9% in 23, 1.9% in 2024. It's a 75 basis point hike today. They're not forecasting a recession right now, and they expect to raise interest rates again over the next few meetings. They're going to go meeting by meeting. But, Tom, I think if you get any criticism of the decision today, it might not be on the policy call. It may well be on the forecasts, because these forecasts are for growth. They are not for a recession as far as I can see.
Well, they're forecasts and they're very political as well. Let's remember there's no statement in there on a war in Ukraine, which has a little bit to this. At least I haven't seen that as well. John, I love the elegance of getting away from data dependency and forward guidance where they just gracefully say, there will be a meeting-by-meeting approach. They do it more elegantly than we do in math-centric Washington.
And this data is moving quickly. I believe we've got Maria Tadeo standing by in Frankfurt. It's been a while, Maria. Typically, I'd spend some time welcoming you back, but we've got some news to cover. Go through the headlines for us.
Yes, and Jonathan, 75 basis points, it was the obvious choice, but it was not a given because the debate around 75 or 50 basis points had really heated up in the days prior. Remember, some in the Governing Council were concerned about the idea of a full-blown energy crisis, potentially hiking aggressively in the face of potentially a recession, which they don't refer to here. They talk about stagflation, but nonetheless, to me, what it shows is that the hawks have it. It's really the hawks that control the Governing Council now, and they really did feel at this point there is a window to hike. The European Central Bank credibility is on the line here. You have to take decisive action here.
Maria, who are the hawks besides the obvious Bundesbank and the people of Germany? Who joins them this morning?
I mean, we've seen this. It's the Dutch. It's also the Austrians. I guess we'll have to find it really to see at this press conference whether this was unanimous or not, because there could be a surprise here where some governing councils who usually may be on the dovish side also feel like it was a good idea to front load a lot of this, especially because if you get to December and that recession does manifest, or you go into this big energy crisis, you could not be or should not be hiking at that point. So this may also be a question about front loading now that you have that window. I think the other key takeaway for me will be any references to Italy. We talk a lot about Germany, but Italy is also a country that is very exposed to that energy story, but also has a change in government, and it's unclear what that is going to look like.
Maria, what does it do for ECB credibility, the fact that they do not forecast recession, that they do forecast growth, as John was pointing out?
Look, I think when you look at this outside of the European Union, it probably seems diluted. It probably seems stupid that they're not operating in the reality that many investors are. But when I talk to European officials, they do always repeat one thing, is that there's two scenarios here. One is the most stressed, in which you enter a recession, in which there is a serious energy crisis, in which, of course, you enter into serious problems with the economy. But they also say there could be a less stressful scenario in which you do not have a cold winter, in which you do see demand going down because it's expensive, because people switch things off, because they don't want to pay for a hefty bill. There's also potentially to come tomorrow measures from the European Commission that could help all of this. They talk about liquidity for companies too. They also talk about intervene in the market so that you make a separation between gas and electricity. They also say they're well advanced on the storage story. So for many European officials, they do believe that there could be a scenario in which you're just able by a stretch to get through the winter without a recession.
Maria, I can take the opportunity now. We missed you. It's good to have you back. Maria Tadeo there from Frankfurt, Germany, on the ECB rate decision. TK, it is 75. And going into this news conference, the euro slightly weaker, 99.94.
John, I launched my chart of the year today, and it is a different 75 basis points in Europe. I would suggest, John, and I defer to you on this with your years of experience in Frankfurt, this is an easy lift for them. The next lift will be far more profound.
Gets harder and harder. And Tom, especially if the economy, growth, does not evolve in the way they anticipate. They're talking about maybe things, Tom, dropping off to what we might be able to call stagnation. Let's face it, we're talking about more than that in Europe right now, Tom. We're talking recession.
Futures flat in America, the VIX 24.95 off what we saw yesterday. DXY under a 110 level, a bit weaker dollar, but some real huge blinking on the Bloomberg terminal this morning. Vassilios Giannakis joins us now of Citigroup. Vassilios, real simple, what is the closest attribute or thing that matters to the ECB after this announcement? Is it GDP? Is it the price of hydrocarbons? Is it what Mr. Putin does? What's the variable that matters now for Lagarde?
Well, the ECB's mandate, the ECB's merit is quite clear, and that is about inflation. So, strictly speaking, it should definitely be the outlook for price growth, the outlook for inflation. And I think today's meeting had two interesting things. First of all, it highlighted the 75 basis points a hike as front-loading. And secondly, it kept on reiterating that meeting-by-meeting approach. And in my view, given the fact that inflation is running at 9% currently, way above the ECB's target, which is slightly below the 2%, it doesn't give me confidence that that inflation is taking priority over everything else. So in that sense, and I think that's the big takeaway from the statement so far, of course, we'll see what the press conference brings us, is that there is still an enormous weight on the growth outlook. And that weight could potentially go up or down depending on how growth pans out. But again, this is not a central bank that communicates that inflation is the top priority, as it should be, and we will find it and we will keep at it, like the Fed said.
Given that, Vasilios, do you expect the euro to decline more significantly versus the dollar, because that, you believe, will ultimately be the message from this rate decision?
Look, I think today's statement so far, absent any major surprises from the press conference, I don't think it's positive. It's supportive of the euro. But outside the ECB, there also the elephant in the room is global growth, and that's the elephant in the room of the euro. As long as global growth remains muted, very muted, and as long as China keeps going on with a zero COVID policy and the unwillingness to stimulate meaningfully, it will not bail out global growth. And as long as this does not happen, it is very unlikely that euro is going to find any support. So, long story short, yes, I'll be selling the euro.
Vasilios Giannakis. Vasilios, great to catch up off the back of this ECB decision. So much more to discuss with you over time. Joining us out of City, it's 75 from the ECB, and I can tell you in about 20 minutes' time, we'll hear from the President of the European Central Bank, Christine Lagarde. Shortly thereafter, we'll hear from Chairman Powell at a separate event. So this is what we'll do at about 8:45 Eastern. That news conference will begin. We'll take that for you. Then when Chairman Powell starts to talk, in an address, a conversation at about 9:10 Eastern time. We'll pick up on that as well. Futures up by about 0.1% on the S&P, on the Nasdaq 100. We are basically unchanged. Tom, off the back of this, euro dollar firmer by maybe 0.1%. It's going to all be about the news conference in 20 minutes' time.
And this is where you go to euro sterling, euro yen, and the others to see what the real tip point is, the balance point. And I would suggest, John, it's really off euro yen, a fractional move here that we see on euro.
Front loading, Bramo. It's 75. What's next?
Yeah, well, that's the question. And is this front loading, meaning that they're going to stop and pause sooner than likely? In other words, are they going to end up with the Alessio De Longus idea that they could possibly reverse course and have a very powerful rally in a couple months' time? It seems very far away when they're prioritizing.
Remember when we used to call the forecast from the Fed aspirational? Yeah. Do you think those GDP forecasts are aspirational?
That's what we just heard about the idea that they're not prioritizing inflation over all else. There still is a growth component.
Up next, Holger Schmieding of Berenberg from New York. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and the electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
Live from New York City this morning. Good morning with Tom Keene and Lisa Rabbits. I'm Jonathan Ferro. Futures are just about positive on the S&P 500. On the S&P 500, we are higher by 0.02%. On the Nasdaq 100, we're negative by 0.07%. You'll hear from the ECB President Christine Lagarde in about 15 minutes' time. Then after that, you'll hear from Chairman Powell. We can hear from Mike McKee, which is so much better. Morning, Mike.
I wish I had a whole lot to tell you here, but we have very small change in jobless claims. They go down 222,000. It's a decrease of 6,000 from the previous week's level. Of course, that's revised to 232,000, revised down from 232 to 228. So it looks like at this point we are still seeing strength in the U.S. labor market. 1,473,000 people getting ongoing claims, so people still getting jobs. That is the good news in the United States. It pales kind of in comparison with what's going on around the rest of the world.
Sure, but it's a data point. It pushes back against the gloom, though, doesn't it, Mike?
It does push. It does push back against the gloom. The latest economic data in the U.S. has been relatively good, but the Fed has been much more hawkish, sort of unitarily so over the last week, which is why pretty much the focus now in the markets has turned to 75 basis points, and we'll see what Jay Powell has to say about that later this morning.
TK, a bit more fuel for those hawks, looking at claims at 222,000.
Michael McKee, 4 weeks in a row down. It gets us back to early summer. What is a level in your head where Michael McKee goes, oh?
I don't know that there's a level because we're in a unique environment where there are so many job openings at this point. I think it would be a continuing rise that didn't really show signs of peaking that would start to get people's attention. This is a signal that things are relatively good, at least as far as corporations are concerned.
Right now, what's the threshold for them to move away from a 75 basis point rate hike? I'm talking about the Federal Reserve at a time when everybody else has gone hawkish, and this is the summer of 75.
Yeah, I mean, you look at the ECB, the most surprising thing to me in their announcement was that they don't see a recession in train, and everybody else seems to. So if they don't see a recession and they're going 75, what's the Fed going to do? Because they don't want a recession either. I think that 75 is pretty much baked in, even if we get a decline in the CPI next week, which is what is forecast on a month-over-month basis, CPI Tuesday. And if we get that, then it's still probably going to be 75. Because
you said it, TK.
As Jim Bullard says, if you're going to get somewhere faster. There's no reason to wait. Yeah.
Front-loading Wednesday.
Mike McKee, thank you. What's Thursday then, Tom?
I haven't figured out.
PPI.
That's retail sales.
Thursday.
Retail sales is Thursday. We have CPI, PPI, and retail sales all in a row just to keep you guys on your toes.
Jobless claims Thursday.
Futures down a tenth on the S&P. On the Nasdaq, we're down 0.2%. Euro dollar, just checking in on the euro for you. We are at just about parity, positive a tenth, Tom. The news conference, 12 minutes away.
Early morning in America, we make light of it with terrific news flow today, but these are serious matters, and particularly with the war in Ukraine pushed up against all the other conversations. And the conversations of Europe are complex, which is why to go from Alessio De Longus to Holger Schmieding, he is chief economist at Berenberg, is our great privilege this morning. Careful conversation on these moments. What will you listen for from Christine Lagarde after she's decided there's no recession ahead?
Well, I will listen, of course, to three things. First of all, what does she say about the future path of interest rates? Does she go beyond this meeting by meeting approach? Any hint whether the next move could be 50, 25, or another big 75? Again, that's the one key thing. Second, I'd love an explanation why they don't yet see a recession. We expect a significant recession in coming months. And third, any comments on the future of their asset purchase programs? More precisely, any comments on could there be some quantitative tightening, some roll-off of expiring bonds from the ECB's balance sheet in the future? Or what do they think, and what do they think about current yield levels? Are they anywhere close to needing this TPI new intervention program in favor of Italy? Probably they are not, but any comment on that would, of course, be most interesting.
Holger Schmieding, what is the power of Ottmar Issing, of Axel Weber, of a Bundesbank culture back to World War II, certainly back to the Reformation of Europe coming out of World War II? What is the Germanic power at the ECB this morning?
Well, say the hawkish viewpoint on rates did prevail. I wouldn't quite call it Germanic power. It is just that we've seen such a surge in inflation that the European Central Bank, like the US Fed, has decided it needs to be seen as fighting inflation. And we'll hear whether this was a consensus. I suppose this was a near unanimous consensus that the ECB at the Council needs to do something significant. And the quid pro quo may have been that the ECB does not, judging by the statement, edge closer towards quantitative tightening. So that's something which the doves may have gotten out of it. But we'll hear at the press conference any comments about that.
Holger, would you call this front-loading or just incredibly delayed?
Well, this is front-loading relative to ECB standards. They haven't done 75 basis points before. That is quite a bit, especially in a situation where many indicators suggest that the economy is heading not just for stagnation, but probably for worse, a recession, which over time will, of course, on its own dampen inflationary pressures.
A lot of journalists listening to your response, Holger, and trying to work out the appropriate question to ask the president in this news conference. Just why isn't she forecasting a recession? Why is the staff of the ECB not forecasting one?
That's a good question. I'd love to listen to that answer, and I will try. And I'm sure one of your colleagues will pose that question at the news conference. My impression is that, the ECB is typically a bit slow in revising these forecasts. They have now meeting after forecast round after forecast round been forced to make significant changes. And secondly, they may be a bit under the impression of the very good data for the second quarter, above trend growth in the Eurozone, and what was in Southern Europe probably a very good tourist season over the summer. But if we still hang in Q3, despite all the bad news about energy, that actually means that the risk that Q4, from a good, still decent Q3, that Q4 could be deeply negative, that risk is actually rising rather than falling. And I'd love to hear the ECB explain why that should be stagnation rather than actual recession.
That's the benefit of the doubt version of things. Then you've got the Vasilios Giannakis take on it, which made him somewhat bearish on the euro, all things being equal, saying it highlights how this is an ECB that still is prioritizing growth in tandem with just fighting inflation, which makes him somewhat concerned. Do you get the same message from the fact that they did not forecast recession, that they're still forecasting growth despite very much higher rates and despite some of the incredible economic pain facing the region?
Well, I don't quite get that impression. I would focus more on it's been 75 basis points. It's been 50 basis points in the meeting before, more than the ECB had indicated beforehand, especially a few months ago. And the ECB has vowed to raise rates further. So I don't think that this decision today exhibits any sort of hesitancy on doing what it takes to tackle inflation. The real question over here is whether anything the ECB can do really will have a significant impact on inflation, as the European inflation, a bit unlike the US inflation, the European inflation is largely a matter, well, of Putin's war against Ukraine, of the sky-high wholesale prices for gas, for electricity, and not the result of any excess consumer demand over here, or not yet, at least, the result of any excess wage pressures.
Is there a pivot point threshold that you're looking for? In other words, is there a point of pain in the economy that might be big enough for the ECB to reverse course?
Well, the ECB probably won't reverse course, but I think that come the beginning of next year, with probably the fourth quarter having been significantly negative, and the outlook likely to be that in the first quarter of next year, the recession will remain pretty deep, that then the ECB will likely go on hold. So the ECB may now raise rates, the main refi rate, to say 2% by December, with a chance it could be a bit above that. But next year, with the economy in a probably quite significant recession, early next year and late this year already, next year I think the ECB will then stay on hold and let the recession and the base effects of inflation do the job of bringing annual inflation down again quite a lot over the course of next year, from probably early spring onwards.
Holger, Christine Lagarde will parse today the difference between Brent crude and natural gas. What is Berenberg's research here on the separation of a much better statistic for a barrel of Brent crude versus the agony of what we see in natural gas right now?
Well, over here, these various sources of energy are very disconnected, in the sense that Brent crude is, of course, one major element of a largely global market for crude oil. And in the global market, we've seen a bit of, well, price easing for oil in response to, well, recession, or at least recession fears. Whereas gas prices, extremely volatile, are up to the calculus, can Europe make it through the winter or not? We are currently modestly optimistic that Europe can make it through the winter without having to ration gas to industry. But the price for that is we in Europe are filling up our storage facilities quite nicely, but we are paying through the nose for it. So natural gas and to some extent electricity reflect the European drive to basically prepare for the winter at almost any cost, whereas oil is a global price, more or less.
Holger, thank you. It's important to get your perspective going into that news conference following that monetary policy decision. Holger Schmieding there of Berenberg. If you're just tuning in, that news conference is about 4 minutes away. At 8:45 Eastern Time, we'll hear from President Lagarde of the European Central Bank. Then at about 9:10 Eastern Time, at a separate event, you'll hear from Chairman Powell. So we'll take the news conference on Bloomberg TV and radio. Then we'll gradually, eventually, shift towards Chairman Powell. About 30 minutes after, we heard from the ECB, and they delivered a 75 basis point rate hike and signaled the may well be more to come. The outlook, well, it's never good. It's never good if you have to upgrade your inflation outlook and cut your growth forecast. So here's the outlook for inflation from the ECB. And I'll quote the team, the Governing Council, directly from their statement. As the current drivers of inflation fade over time and the normalization of monetary policy works its way through to the economy and price setting, inflation will come down. But here's the but. Looking ahead, ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 2022, 5.5% in 2023, and 2.3% in 2024. We talked about the forecasts on growth and question as to whether they are so-called aspirational. Are they aspirational forecasts, considering that the forecasts that I see on growth right now do not include a recession? They say this: after a rebound in the first half of 2022, recent data points to a substantial slowdown in Eurozone economic growth, with the economy expected to stagnate later in the year and in the first quarter of 2023. They talk about the energy backdrop. They say very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they're still constraining economic activity. The forecasts from the staff at the ECB now look like this. They expect the economy to grow by 3.1% in 2022, 0.9% in 2023, and 1.9% in 2024. And I imagine those growth forecasts will be questioned in this news conference about 2 minutes away. From Frankfurt, outside the ECB, just before this news conference begins, is Maria Tadeo. Maria, can you run me through where you think the line of questioning will begin with this ECB president?
Well, I think number one is, and you alluded to this, isn't this too optimistic? We're entering in a winter that potentially for some looks almost apocalyptic for the European economy. Again, this goes back to what I mentioned earlier, which is behind the scenes, there's still officials in both Frankfurt but also Brussels who believe they can avoid that recession scenario, who still say we have not played our cards here. We can still deal with the gas situation, put a cap on it. We can separate electricity to demand destruction. That will be key. They're aiming for 10%. If that happens, perhaps they're able to wing it. They also talk about liquidity for all of these companies, fiscal support. A lot of this coming together could mean that just by a stretch, they're able to get through this winter without a recession. A lot of this, by the way, will depend on something that Christine Lagarde cannot control, and that is the weather. Is this going to be a cold winter? Will it be a mild winter? So I think you can call this wishful thinking, and I guess, you can blame investors for saying this is wishful thinking, but for them is one of the options that's on the table, and they don't want to talk down the economy further.
Biggest hike ever for the ECB. Maria, thank you. That news conference with President Lagarde starting imminently in Frankfurt. When it begins, we'll head over to it. Lisa, do you think it's aspirational? Dare I say, I could be on the edge of being rude here, are those forecasts laughable for the European economy?
A lot of people, including some bank CEOs, would probably say yes, that they are laughable to just assume there will not be a recession as a base case, even as you hike rates into weakening growth, given the fact that they're still projecting inflation rates miles away from where the central bank needs to see them. Interesting to see how they explain that.
Tom, you've seen a lot of decisions over the years, plenty of forecasts. What do you make of this decision and these forecasts?
Well, to me, the decision is a backdrop against their economic might and their productivity, given the huge uncertainty of a war. And as I said earlier, John, to me, the decision is the Fed has acted, and the Fed is searching in the gloom, and maybe we'll see that at the Cato Institute today, towards some form of neutrality, some form of we're there. I don't think we have a clue where there is for the ECB.
And Lisa, to be fair for this ECB and the leadership of the European Central Bank, so much of this is out of their control. Gas prices, a war, a policy decision that is out of their hands. It's up to European governments to decide what they're going to do, something radically different from the UK. We'll get something different from Germany, from Italy. Can we get a big agreement at the European level to do something? Is it about curtailing demand? So much of these things that have huge implications for them and their decision are totally out of their hands.
This is a difficult situation for the ECB, which is one reason why I personally am wondering whether tomorrow's meeting of finance ministers, energy finance ministers in Europe is going to be more important for markets than this rate decision, because right now the ECB is looking into the same cloudy mess that the rest of us are doing.
I couldn't agree with you more. When we look at the outlook for the ECB right now, I'm less interested in their forecasts. I'm more interested in the price of gas next year. And if they could have that price right now, then imagine how much more confident they'd be about what they have to do.
Although, will they actually then project that they're going to get some sort of growth still, or would it be the opposite, right? I mean, if you have to think about the pain that would be required to do this, we see this in the UK, and the reality that we're seeing over there, why is it not being reflected by any other central bank, even though, to a lesser degree, other banks are facing the same outlook?
We can head over to the ECB chief right now. Let's listen in.
Good break. So, today, the Vice President and I welcome you to our press conference. The Governing Council today decided to raise the 3 key ECB interest rates by 75 basis points. This major step frontloads the transition from the prevailing highly accommodative level of policy rates towards levels that will ensure the timely return of inflation to our 2% medium-term target. Based on our current assessment, over the next several meetings, we expect to raise interest rates further to dampen demand and guard against the risk of a persistent upward shift in inflation expectations. We will regularly re-evaluate our policy path in light of incoming information and the evolving inflation outlook. Our future policy rate decisions will continue to be data dependent and follow a meeting-by-meeting approach. We took today's decision and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period. According to Eurostat's flash estimate, inflation reached 9.5% in August. Soaring inflation and food prices, demand pressures in some sectors owing to the reopening of the economy, and supply bottlenecks are still driving up inflation. Price pressures have continued to strengthen and broaden across the economy, and inflation may rise further in the near term. As the current drivers of inflation fade over time, and the normalization of our monetary policy works its way through the economy and price setting, inflation will come down. Looking ahead, ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 22, 5.5% in 23, and 2.3% in 24. After a rebound in the first half of 22, recent data point to a substantial slowdown in euro area economic growth, with the economy expected to stagnate later in the year and in the first quarter of 23. Very high energy prices are reducing the purchasing power of people's incomes, and although supply bottlenecks are easing, they are still constraining economic activity. In addition, the adverse geopolitical situation, especially Russia's unjustified aggression towards Ukraine, is weighing on the confidence of businesses and consumers. This outlook is reflected in the latest staff projections for economic growth, which have been revised down markedly for the remainder of the current year and throughout 23. Staff now expects the economy to grow by 3.1% in 22, 0.9% in 23, and 1.9% in 24. The lasting vulnerabilities caused by the pandemic still pose a risk to the smooth transmission of our monetary policy. The Governing Council will therefore continue applying flexibility in reinvesting redemptions coming due in the Pandemic Emergency Purchase Programme portfolio, with a view to countering risk to the transmission mechanism related to the pandemic. The decisions taken up today are set out in a press release available on our website. A separate technical press release on the remuneration of government deposits will be published at 3:45. I will now outline in more detail how we see the economy and inflation developing and will then explain our assessment of financial and monetary conditions. The euro area economy grew by 0.8% in the second quarter of 2022, mainly owing to strong consumer spending on contact-intensive services as a result of the lifting of pandemic-related restrictions. Over the summer, as people traveled more, countries with large tourism sectors benefited especially. At the same time, businesses suffered from high energy costs and continued supply bottlenecks, although the latter have been gradually easing. While buoyant tourism has been supporting economic growth during the third quarter, we expect the economy to slow down substantially over the remainder of this year. There are four main reasons behind this. First, high inflation is dampening spending and production throughout the economy. And these headwinds are reinforced by gas supply disruptions. Second, the strong rebound in demand for services that came with the reopening of the economy will lose steam in the coming months. Third, the weakening in global demand, also in the context of tighter monetary policy in many major economies, and the worsening terms of trade will mean less support for the euro area economy. And fourth, uncertainty remains high and confidence is falling sharply. At the same time, the labor market has remained robust, supporting economic activity. Employment increased by more than 600,000 people in the second quarter of 2022, and the unemployment rate stood at a historical low of 6.6% in July. Total hours worked increased further by 0.6% in the second quarter of 2022 and have surpassed their pre-pandemic levels. Looking ahead, the slowing economy is likely to lead to some increase in the unemployment rate. Fiscal support measures to cushion the impact of higher energy prices should be temporary and targeted at the most vulnerable households and firms to limit the risk of fueling inflationary pressures, to enhance the efficiency of public spending, and to preserve debt sustainability. Structural policies should aim at raising the euro area's growth potential and supporting its resilience. Inflation rose further to 9.1% in August. Energy price inflation remained extremely elevated at 38.3%, and it was again the dominant component of overall inflation. Market-based indicators suggest that in the near term, oil prices will moderate, while wholesale gas prices will stay extraordinarily high. Food price inflation also rose in August to 10.6%, partly reflecting higher input costs related to energy, disruptions of trade in food commodities, and adverse weather conditions. While supply bottlenecks have been easing, these continue to gradually feed through to consumer prices and are putting upward pressure on inflation, as is recovering demand in the services sector. The depreciation of the euro has also added to the build-up of inflationary pressures. Price pressures are spreading across more and more sectors, in part owing to the impact of high energy costs across the whole economy. Accordingly, measures of underlying inflation remain at elevated levels, and the latest staff projections see inflation excluding food and energy reaching 3.9% in 2022, 3.4% in 2023, and 2.3% in 2024. Resilient labor markets and some catch-up to compensate for higher inflation are likely to support growth in wages. At the same time, incoming data and recent wage agreements indicate that wage dynamics remain contained overall. Most measures of longer-term inflation expectations currently stand at around 2%, although recent above-target revisions to some indicators warrant continued monitoring. Let's turn to our risk assessment now. In the context of the slowing global economy, risks to growth are primarily on the downside, in particular in the near term. As reflected in the downside scenario in the staff projections, a long-lasting war in Ukraine remains a significant risk to growth, especially if firms and households faced rationing of energy supplies. In such a situation, confidence could deteriorate further and supply-side constraints could worsen again. Energy and food costs could also remain persistently higher than expected. A further deterioration in the global economic outlook could be an additional drag on euro area external demand. The risks to the inflation outlook are primarily on the upside. In the same way as for growth, the major risk in the short term is a further disruption of energy supplies. Over the medium term, inflation may turn out to be higher than expected because of a persistent worsening of the production capacity of the euro area economy, further increases in energy and food prices, a rise in inflation expectations above our targets, or higher than anticipated wage rises. However, if energy costs were to decline or demand were to weaken over the medium term, it would lower pressures on prices. Let's look at the financial and monetary conditions now. Market interest rates have increased in anticipation of further monetary policy normalization in response to the inflation outlook. Credit to firms has become more expensive over recent months, and bank lending rates for households now stand at their highest levels in more than 5 years. In terms of volumes, bank lending to firms has so far remained strong, in part reflecting the need to finance high production costs and inventory building. Mortgage lending to households is moderating because of tightening credit standards, rising borrowing costs, and weak consumer confidence. Summing up, we raised the 3 key ECB interest rates by 75 basis points today and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period. This major step front-loads the transition from the prevailing highly accommodative level of policy rates towards levels that will support a timely return of inflation to our 2% medium-term target. Our future policy rate decisions will continue to be data-dependent and follow a meeting-by-meeting approach. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term inflation target. We are now ready to take your questions.
Thank you, Madame Lagarde. The first question goes to Luke Heighton of Market News International.
Good afternoon, President Lagarde. 2 questions, if I may. The first, could you give us a flavour of the Governing Council's discussions, the arguments for and against that led to today's decision to raise rates by 75 basis points and not, for example, 50 or 100 basis points? And then my second question, from the present standpoint, how close to both the neutral rate of interest and the expected terminal rate does today's decision bring us, in your view? Thank you.
Thank you very much for these 2 questions. I'll take them in turn. On your first question, The Governing Council unanimously decided to raise the three key ECB rates by 75 basis points. We had different views around the table, a thorough discussion, but the outcome of our discussions was a unanimous decision. So how did we come to that decision? As I have said before, and as I have repeated in that monetary policy statement, since our last July meeting, we are data dependent and operate meeting by meeting. This is the methodology that we adopt. So we were presented by staff with their projection. We had the inflation numbers and the growth outlook, of course. So in the face of these extremely high numbers, the last reading was 9.1 for a monthly reading. But if you look at the last 10 readings, they were the last 10 highest readings in turn. We had a good analysis of the decomposition of the sources of inflation, a good analysis of where the inflation actually lies and what products are particularly affected. And while we conclude, of course, that energy is still the major source of inflation, it's 38.3% compared with a year ago, slightly moving down in these August numbers. But it is still a dominant factor, as is the increase in food. But we also have an inflation that spreads across the whole range of products, in particular in the service sector, where supply factors are less prevalent and where demand plays a role. So we have a range of the product and services that are actually north of 4%. So in the face of an inflation that is extremely high, that is of a magnitude and persistence across sectors of that nature, obviously determined action had to be taken. And this is very much in line with our determination to actually normalize monetary policy as we started back in December. So for those who consistently repeat that the European Central Bank is lagging behind, I contend that we are on a journey that started back in December, where we decided to put an end to the asset purchases under PEP and under APP, to move out of negative interest rates as we did back in July, and now to continue on our normalization path with a front-loading exercise that we conducted today, because we believe that the deviation from target is such that it warrants this front-loading. And we also decided that this was not an isolated decision, but that we would raise interest rates further. We didn't say that we would raise interest rates at 75% as if 75 was the norm. It is not. We will determine, meeting by meeting, on the basis of data, how we reach to that level of interest which will actually return us to the 2% target in the medium term. It is not there at the moment. Our forecast at the end of December, which is not the medium term, but it's the end of our projection exercise, is at 2.3. We are not there. So we have more journey to cover going forward. But we had a very, you were interested in the flavor of the Governing Council. We had a very cordial, effective, deep discussion on all these matters. And that certainly helped us on the basis of the proposals by staff and the recommendation by our chief economist, Philip Lane, to actually go collectively in the direction of this 75 basis points hike. Now, you asked me about how close we are to the rate. Whether you call it a neutral or terminal is obviously different. But I would like to say this. What I know today is that 0 is not the neutral rate, and that where we are is not the neutral rate. We are heading in that direction. It takes a front loading. It will take further hikes in the next several meetings of a magnitude and at a pace that will be determined meeting by meeting and on the basis of the data that we receive. But we are certainly heading there because that's where we believe that we will actually deliver on our 2% medium-term target as indicated in our strategy.
Thank you, President. The next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much for taking my question. I have one on quantitative tightening, because clearly that could be also a way to drain liquidity from the system and help you to tame inflation. Have you discussed it? Is that something you're looking at? And then one question about your economic outlook, because clearly for 2023, you are seeing growth coming back to 0.9%, if I'm right. But this is still quite optimistic compared to other forecasts. So
that's 24.
24, yeah.
1.9.
Okay, but for next year, why don't you see a recession? Because many economists do see one. Thank you.
Let me start with the second one. So the baseline outlook is 3.1 for 22, 1.9 for 23, and sorry, see, I'm getting confused as well now. So back, 3.1 for 22, 0.9 for 23, and 1.9 for 24. So that's the baseline that we have in the projection by staff. We also have, and I think you will be receiving those documents as well, we also have a downside scenario that has been produced by staff on the basis of assumptions of risks in particular, some of which have already materialized. And in those numbers, you will see that from memory, growth outlook is at 2.9 for 22, is at minus 0.9 for 23, and at 1.9 again for 24. So while even in our baseline, we foresee some stagnation for the last quarter of 22 and the first quarter of 23, in the baseline, we don't forecast negative growth in 23. In the downside scenario, we do. That downside scenario differs from the current situation in that it includes, in particular, total shutdown of all Russian gas supply. Well, we're almost there. There's still a bit of flow going through the Ukrainian ones. But we also foresee rationing across the whole euro area and no measure of compensation between the shortage of gas supply and other alternative sources of supply. So nothing coming from, either Asia or other producers of gas. And in particular, I don't think we take into account the LNG that we could be sourcing from, more of it from Norway or from the United States. So it's a really dark downside scenario, but it's one that concludes to a 23 recession. But it's the downside scenario, it's not the baseline. Okay. So on the issue of quantitative tightening, what we are focused on at present is the most effective and most proportionate and most appropriate monetary policy instrument that we can use. And we believe at the moment that it is the policy rate. So we are using the policy rate. We will continue using that policy rate in the next several meetings, as I have said. And of course, we will look at other monetary policy instruments. But at this point in time, it is still premature. But it is a matter that we will, of course, debate amongst members of the Governing Council in due course.
Thank you, President Lagarde. And the next question goes to... Sorry.
You've been listening to the ECB chief, President Lagarde, speaking from Frankfurt. At the same time, we're hearing from Chair Powell, Chair Jay Powell of the Federal Reserve in Washington. Let's drop in and take a listen to what he's got to say.
That intense political pressure that might be brought to bear to avoid collateral economic damage before the inflation fight is won. And I just wondered if there's any way you can help me sleep a little bit better on that score.
Sure. So I think it's worth going back and remembering, and I pointed this out in my remarks 2 weeks ago at Jackson Hole, 10 days ago, that what Paul Volcker did and the Fed did to finally get inflation under control followed several failed attempts to get inflation under control. And what had happened over the course of that long period of the Great Inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view and my view that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done to avoid that. We think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not. We focus solely on the goals that Congress has given us, and that's what we're going to do here.
I think that that's really important because it's clear that we could see political pressure coming to avoid economic costs when there could be claims from political players that inflation is back in its box long before it is. Jim mentioned in his opening remarks that 2 years ago you moved to a new framework, flexible average inflation targeting, and I'm bringing this up now because again, just reiterating the point about trying to sleep better at night. By many accounts, this move has created some more uncertainty in the market, as Jim mentioned. And coming at a time when inflation now has increased so markedly, it creates concern that despite your stated resolve, the commitment to price stability has become less strong. Should you consider modifications to this framework to assuage these concerns and better manage short-term expectations?
So the framework, we began the work on the new framework in 2018, and we announced the results in August of 2020. And it really followed 25 years, basically, of global disinflationary forces. And the problem was that monetary policy rates were close to the effective lower bound much too much of the time, much too close, and even during good times. So that meant that central banks were having a hard time all over the world, finding ways to support the economy when it was needed. And that's why central banks, including the Fed, resorted to things like forward guidance and asset purchases. So that's why we did that. But the changes that we made were sort of a very mainstream part of a literature around makeup strategies. But really the point of our framework changes, the point of all of them was to, and we said this very clearly, was to have inflation expectations well anchored at 2%. That the average inflation targeting idea was meant to support having inflation expectations. That is the goal at 2%. And the reason is that we believe that the public's expectations of future inflation will play an important role in the actual path of inflation. So that is kind of the fundamental basis of our framework. And as I just discussed, it is very important that inflation expectations remain anchored. I think the evidence today is that if you look at longer term expectations by households, businesses, and forecasters, and also markets, you'll see that they are pretty well anchored around 2%. Of course, short term expectations are higher because of high current inflation, and also the clock is ticking. As I mentioned, the longer that inflation remains well above target, the greater the concern that the public will start to just naturally incorporate higher inflation into its economic decision making. And our job is to make sure that doesn't happen. And we're committed to doing that job.
It seems to me there's a chance that there's a real risk that the labor market, that the labor shortages persist. Does that create a risk that takes some of the ability to manage this process out of your hands? To the extent that there continue to be labor shortages, does that then feed into expectations that the public has about inflation, as you mentioned very prominently?
Well, I think you're right that if it does turn out that we are in a world of a persistent labor shortage over time, that'll be a challenging world for companies, and it will certainly create upward pressure on wages and that sort of thing. Today, the labor market demand is very, very strong still in the labor market. We're still printing new payroll job numbers at a high level. Wages are running at elevated levels. And so we think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance. And that will bring wages back down to levels that are more consistent with 2% inflation over time. That's what we're trying to achieve. The shock to labor supply that we got from the pandemic was large and unexpected, and unfortunately persistent. I will say that just in the very last labor market report that we got last Friday, we did see a welcome increase in labor force participation. Nonetheless, still a full percentage point below where it was before the crisis. And I think it's important as a society that we have measures in place to support a strong labor market and high labor force participation. And that goes beyond what we can accomplish with monetary policy.
You've made some contrast to how things are different today. What's different today from the high inflationary period of the late 70s and early 80s? I guess some other distinctions are, I remember as a student in Boston in the early 80s, in the days before the internet, I remember seeing people actually line up at the Fidelity office to see the monetary aggregates released on a weekly basis. And the way the money travels through the economy has changed dramatically since Milton Friedman first said that inflation's always and everywhere a monetary phenomenon. I'm just wondering, how do you respond when people look to the huge spike in government spending and say, I think you answered this in part in the first question, but that when you look at the huge spike in spending and say the Fed's printed all this money, so of course we have inflation.
So I graduated from college in 1975, which was close to peak monetarism, and there was quite a focus on monetary aggregates, and I recall it just as you do. So to go to this current situation, so as part of our response to the pandemic, we did resort to large asset purchases to address what were pretty severe disruptions in markets, and then also to support the economy, and our balance sheet expanded dramatically. But remember that our purchases of securities don't actually increase the quantity of government obligations held by the public. They really change the mix because we issue bank reserves to pay for those securities. So we're not changing, the quantity of obligations. That is not to say that money growth wasn't high. It was, of course, extraordinarily high in 2020, and then slowed down in 21, and now is quite sluggish. And I guess I would just say it this way. Whatever caused, there are different theories on what caused the inflation that so suddenly jumped up out of the ground in March of 2021. Whatever that cause was, the relationship between the money supply and inflation, economic output, has been much more unstable than it was in Friedman's day for a very long time. And so literally changes in monetary aggregates have not had a consistent, reliable relationship. They haven't been a good predictor of the economy or of inflation. Now, of course, the economy is ever changing, and that too could change, to where it is important again. But for now, and for really many years now, monetary aggregates don't play an important role in our formulation of policy, and we don't think they're generally a good way to think about policy or about inflation. It's more about demand and supply and things like that. So that's where we would be on that.
That actually calls to mind, at Cato, we do have a strong aversion to a fully discretionary fiat money system. And so we do like to socialize and promote alternative frameworks that could put policy and a market direction that eliminates some of this discretion. Jim mentioned that a consistent theme over the years of this conference has been, potential monetary rules. And, that kind of calls into question whether inflation and prices are really the best targets to use for monetary policy. Some folks have advocated for a rules-based system, such as, targeting nominal GDP is something we've heard a lot about in recent years, partly because, as you say, monetary policy is not suited to address, well suited to address supply shocks. Could you share with us some of your thoughts of that type of approach and whether it's something that you would consider?
So more broadly on rules, of course, Taylor rules have become part of the fabric of economic analysis and particularly monetary policy analysis in ways that must be far greater than John Taylor could have hoped when he wrote his original article in 1993. So, but no central bank and the Fed has never explicitly tied our monetary policy decisions to any formula, including Taylor rules. But Taylor rules, nonetheless, are ubiquitous in all of the work that we do. You have to have a variable, or a way and a model of explaining how monetary policy will react, and some kind of Taylor rule is now very much part of the way we think. In terms of nominal income targeting, and by the way, I know that Cato is one of the home courts for nominal income targeting, along with Mercatus and some others. And I know that this is a lot of well-known experts, many of them at your institution, do support nominal income targeting. And I'll just say that, we've looked at that. I've looked at that and really come to the view that nominal income targeting is not the right way to go. And I'll try to explain why. By the way, I know that these arguments are well known to nominal income targeters and will be found to be unpersuasive. But nonetheless, I'll just give you my
and one thing I would interject is that we have debates internally as well. And I think for us, the concept really is more wanting to socialize a number of alternatives and try to move towards alternatives that do have more of a market basis and again, remove discretion. I
think that's a very healthy process. And, the whole debate over many, many years about rules and discretion is a fascinating and important one that is far from over. So it's really a mix of the two. I think but getting to nominal income targeting, we've got a dual mandate: maximum employment and price stability. And it comes down to, is nominal income targeting the best way to promote that? We don't think it is. I don't really think it is. And part of that just is that it would be, I think, very difficult to explain to the public the relationship of a nominal income target, nominal GDP target to those goals. It's a level of complexity that, even some economists and policymakers struggle with, let alone the general public. So it seems like it would be a reach to sort of put that, for us to have that be our fundamental framework. And a couple of examples that would be difficult. One in particular would be, what do you do with changes in trend growth? We have, highly uncertain estimates of levels of trend growth that we amend down through the years, and many years later, we may have a very different view. But it is broadly understood, I think, or thought that trend growth has declined considerably over the course of since the global financial crisis. So how do you incorporate that into a nominal income target? Do you just raise the contribution of inflation, or do you annually re-estimate trend growth? And if you do that, you're incorporating both communications issues, but also, just big chances of policy error, because we just don't know these things with that kind of, we don't know any of the starred variables, so to speak, with that level of certainty. So I'll just say it's a really interesting, and it works very well in models, but it seems difficult to implement from a practical standpoint, and it's not something that we have chosen to do or that we are currently looking at.
You mentioned the dual mandate. I don't want to ignore the unemployment rate during this conversation. When I said earlier that we obviously have an aversion to a fully discretionary monetary system, many of us also regret the adoption of the dual mandate in lieu of a strict focus on monetary stability. The Fed's own website acknowledges that maximum employment is driven mainly by non-monetary factors. And if we accept that, does it really make sense for employment to be part of the Fed's mandate?
So, Peter, as you know, we're created by Congress in statute, and Congress assigns our goals, and it has assigned maximum employment and price stability. It's my view that the dual mandate has served the public well and is generally workable. In particular, at the moment, I don't see the two goals as in conflict at all, because without price stability, we will not be able to achieve the kind of strong labor market that we want for a sustained period that benefits all. So I don't see a case for moving to a single mandate, but that's really a question for Congress, and we will of course implement whatever mandate Congress gives us. To your point about maximum employment, it's true that, and we do say that and have for some time, that non-monetary factors are really what drives the level of maximum employment, which clearly changes through the business cycle and over time. But we can and do assess that, and we do it transparency. And Congress has said that should be a goal, a co-equal goal with price stability. So that's what we're implementing. And again, I don't think there's a strong case for changing that. I don't think it hampers us in our pursuit. And I think we can achieve both goals in the medium term.
You stole my follow-up because you started out saying Congress sets the mandate, and so my follow-up was going to be, well, should the mandate, should they consider changing the mandate? And I think you've answered that. But I guess a natural follow-up might be then that if the dual mandate weren't enough, there's been talk of adding more elements to the Fed's objectives, including like racial equity that seem far from the Fed's ability to address. In addition, the Fed's remit has expanded from the banking system to the broader financial system, and its regulatory responsibilities were widely expanded in the wake of the financial crisis. How does continuing expanding the Fed's mandates not undermine focus on that fundamental responsibility of monetary stability, beyond things such as the employment element of the mandate?
So I think our current mandate is appropriate, and I would not want to see it narrowed or broadened for that matter. We've got narrow and we've got well-defined goals that we're supposed to pursue. And what we've gotten with that is a precious grant of independence that lets us pursue those goals without direct political control. For monetary policy, that's maximum employment and price stability. And I think that dual mandate has served the public well. I really don't think it would not be a good idea to broaden it to goals that might be inconsistent with those two mandates, and that would be very difficult for us to achieve with our tools. More broadly than that, though, I think it's really important that we stick to our assigned tasks and resist the temptation to take on issues that are the province of elected representatives or of Congress. And if we do that, if we do stray from our core mandates, that will eventually undermine the case for our remaining independent. And I think, Fed independence is an institutional arrangement that has served the public well, and I think that's pretty well documented and accepted.
I mentioned a couple of times, our concern about a fully discretionary system, and one of the biggest of those concerns is that in the face of large economic dislocations, we've been running, what really amount to unprecedented experiments. I would cite the quadrupling of the Fed's balance sheet in the wake of the 2008 financial crisis, and then doubling it again during the pandemic. To your credit, it was right before the pandemic that you were beginning to move towards reducing the balance sheet. Could you shed some light for us on where you hope to take the balance sheet over time, and what's the way that you really try to get there? Do you see the Fed ever moving back to a scarce reserve framework like it had before the 2008 crisis?
Sure. So in the last cycle, after we ended our asset purchases, we froze the size of the balance sheet in 2014 and then allowed it to shrink passively relative to the size of the economy for about 3 years. So as the economy grew, the balance sheet didn't grow. Then in 2017, we began to allow maturing assets to run off, and that process went on until 2019. By the end of that period, we had a balance sheet that was significantly smaller relative to the size of the economy and smaller than it was overall. So then we resumed asset purchases, as you know, 2020, and once again now we are embarked on shrinking the balance sheet, and the test will be back to levels that satisfy the public's demand for our liabilities. That's currency and reserves and things like that, but also with reserves maintained at levels that are consistent with our ample reserves regime. So the balance sheet is substantially larger now, obviously, and consequently the runoff process is designed to be substantially faster than in the last cycle, to the tune of on the order of $1 trillion of runoff per year. That process began in June, once it's up to full speed. The process began in June, and the pace of the balance sheet increases, actually rises this month. The plans are spelled out in detail on our website around the January and May meetings. And of course, one thing we always say is that we're prepared to adjust the details of the plan based on economic and market developments at any time. As far as returning to a scarce reserve regime, I guess I would say that I think that our current operating framework is a better one, and I don't see a case for returning to scarce reserves. Now, why is that? So the world has really changed as a result of the global financial crisis and the pandemic. The scarce reserves framework would be challenged to work in a world where there's very high and sometimes volatile demand for safe and liquid assets. Central banks may need to rely on large-scale asset purchases again from time to time in response to severe shocks. And remember that the large financial institutions hold very, very large quantities of safe assets now as a liquidity buffer, and that includes a lot of reserves. So the bottom line is that the quantity of reserves is just so much higher. It would seem to be impractical to try to manage scarcity, and demand will be volatile too. So it doesn't seem practical. And again, we think that the current system works well and provides a lot of liquidity to the system, which is kind of a net gain.
All right, I thought it might be time to shift gears a little bit away from inflation and monetary policy. I remember the first year I joined Cato, I read an op-ed in the Wall Street Journal advocating for the Fed to implement a digital currency. And I was kind of horrified at the privacy implications of this prospect and said so in a letter to the editor at that time. Since then, the Fed has formally stepped into the digital currency ring, and digital currency has obviously been a very recurring theme in these conferences, but the Fed has stepped into this arena with a discussion paper on a central bank digital currency and several speeches from Fed governors. Our team has reviewed the more than 2,000 comments that the Fed's central bank digital currency discussion paper received, and we find that about 2/3 of them are concerned or outright opposed to the idea. Commenters raised concerns of financial privacy, financial oppression, and disintermediating the bank system, some of the same concerns that led me to write that letter to the editor 7 years ago. How can these serious concerns about privacy and freedom be reconciled with a digital currency?
Let me start by saying that we haven't made any decisions at all about whether to issue a CBDC, and we continue to evaluate the pros and cons and look at the technical questions and the policy questions, and we expect that evaluation process is going to take some time, appropriately so. Secondly, I'll say that we do not intend to proceed with issuance of a CBDC without clear support from both the executive branch and from Congress, ideally in the form of a specific authorizing law. So we did it was very gratifying, 2,000 and some comments. And, I won't tell you that I've read those, but I've read all of them, but I've read some of them and I've read the summaries. And, it's a lot of very thoughtful concerns, including the ones that you raised. And there are things that we're considering very seriously. So we in our own paper, we suggested that a CBDC in our jurisdiction should be privacy protected, intermediated, widely transferable, and identity verified. So on privacy protection, let's start with that. Very, very important. And we all see what's happening with the digital RMB. And the issues with privacy. We would not want a world in which the government sees in real time every money transfer that anyone makes with a CBDC. That would not be something that would be at all attractive in the American context. So privacy protection is going to be extremely important, and we're attentive to striking a balance, of course, between law enforcement and privacy protection. But that can be managed in the same way that it's currently managed in the banking system, or in some similar way. In terms of another issue, really is disintermediation, and that really is a question of, if, say, you had an interest-bearing CBDC, it could be attractive. It could compete with deposits, could draw deposits out of the banking system. That could limit credit availability. That's another issue to be managed. I think one of the things that actually that Cato mentioned in your was also the run risk issue, and that is the question of, are you creating an asset that would be very attractive in a panic or severe stress situation, and fostering runs. So look, it's going to be, as I mentioned, it's going to be, we think our role is this. We want to carefully and thoroughly analyze the public policy and technological challenges, public policy trade-offs and technological challenges. That's what we're doing. The idea is that this will lead all of us to a better understanding of those trade-offs and prepare the way for, hopefully, a well-informed decision on whether and when to issue a dollar central bank digital currency. That's what we think our role is. And we think that the Fed is the right institution to do that. We can proceed without, we're a nonpartisan institution, non-political institution that can do these things, and I hope present conclusions and analysis that will support an intelligent decision when it's time to make that.
Well, this is something we'll definitely be having a lot to say on in the future as well, particularly from a perspective of privacy concerns. That's being a watchdog on those issues is a very important role for Cato. I do want to ask about cryptocurrency, but first I should probably, in fairness, reveal that the gentleman who photobombed Janet Yellen 5 years ago by holding up a buy Bitcoin sign behind her during her Humphrey Hawkins testimony earlier this year became my son-in-law. So that's a little bit of a disclaimer I'm going to put out there. But without debating the merits or future of cryptocurrencies generally, or one or another crypto products, I'll say that in the monetary arena, Cato stands for nothing if not a desire to see more interest in monetary policy, to see more people concerned about our discretionary fiat system. And also, we want to see private market innovation and experimentation in developing alternatives. And crypto is just such a great example of this. There's a long history of government and regulation thwarting such innovation and experimentation, which we find really disappointing. So I wonder if you could respond to these kinds of concerns, namely that regulators might ultimately strangle crypto to the extent that it really does develop into a viable alternative system.
So I'll talk about it in two pieces. One is unbacked cryptocurrencies as such, and those have not and don't appear to offer, have not offered and don't appear to offer much in the way of public interest in using them as payments. Let's say it's not a great store of value. What it is a speculative asset. It's not backed by anything.
There could be an argument that that's still during the development phase, and that it's something that we could see emerge. But
yes,
be that as it may.
And I also have close-in family members who offer that perspective vigorously. So, as you suggest, but stablecoins is a different thing, and the question is, are there forms of private money like stablecoins which can play a role in our financial system, which would, and the answer is, of course, that we don't want to stand in the way of appropriate innovation, particularly including, digital innovation. But we think that something like that, which is, purporting to be money, would need to be appropriately regulated. And I hear that wide agreement on that, by the way, from a lot of the stablecoin companies now are seeing that as part of getting to a place where they are a legitimate part of the financial system. So I think you need regulation. If people are going to think something is money, then it needs to actually have the qualities of money. And if it doesn't, then you don't want I don't think you want to take money and make it into just another consumer product where sometimes it fails and sometimes it's good. You want it to be guaranteed to be good. If the public's going to look at it like it was $1, you want to have clarity, transparency. You want to have full reserves of very liquid, high quality assets and things like that. That's all. So I think that we need legislation on this. Just, it's typical of technological innovations. There isn't a regulatory framework that really gets after payment stable coins, and so I think that's what's needed. But I wouldn't think of us as being opposed to that kind of innovation. We're more the people who are saying, among others, that we need appropriate regulation.
Mm-hmm. Yeah, and the devil's ultimately in the details. I mean, while we have these debates, I mean, we would concede, we're living in a world where we will see innovation, and we've basically promoted, a light touch, market focused approach, because there is a real risk of again, having an impact on the development of these innovations and really thwarting what could be very promising and useful innovation.
No, and I agree with that. We don't want to be in that place. We want to be in favor of innovation, but also appropriate regulation.
Mm-hmm. And ultimately, some of the people who end up driving, the regulation might be, as you mentioned, legislation. The end product may not meet the objectives that you and I both say that we want. Another topic, as long as I can remember, successive chairmen have warned of our unsustainable fiscal path. Regrettably, no one in Congress or the White House seems to be listening. I'm, particularly during a period of high inflation, I've been, continually chagrined at, the number of big spending bills that continue to come down the pike and legislation that's passed. Long after I think the crisis of the pandemic has ended. The lessons of the financial crisis and COVID might be that keeping our fiscal house in order is essential as preparation to meet the challenges of unexpected but inevitable, economic dislocations. But the opposite lesson seems to have been learned, that we can keep spending, whatever we wish without worrying about a day of reckoning. And I just, I'm very concerned about the day of reckoning and what risks we're laying for the economic well-being of future generations. And I just wonder, your thoughts on those concerns and the potential timing of that day's arrival and its consequences, and whether you have any ideas about how we can build a real constituency for fiscal responsibility in America.
So I do share those concerns, and in fact, I was working on those issues before I joined the Fed. But at the Fed, my position needs to be that fiscal policy really is the responsibility of Congress and the administration. Wouldn't be appropriate for me to comment too much on specific policy proposals or laws. More to the point, with inflation running so far above 2%, this is probably an especially good time to focus on achieving our own mandate rather than doling out advice to others. But like my predecessors, I'll point out that our federal fiscal policy is not on a sustainable path, and it really hasn't been for some time. And we will need to get back to a sustainable path sooner or later. To your point, sooner is better than later. And I guess I'll just leave it at that.
All right, thanks. We're getting close to the end of our time, so I'm thinking about a closing question. I wonder, with everything that we've discussed thus far, what are some of the key lessons that you've learned since you became Fed chair, and what advice might you give to a lot of the young, monetary scholars out there that Cato and other places are working to develop?
So I guess I would say that both experience and also studying history are great teachers of what can be hard lessons. And I actually mentioned 3 lessons at Jackson Hole 10 days ago, and those were first that the Fed does have and accept responsibility for price stability. Even now, some are questioning that, but that to us is settled. Secondly, that inflation expectations are really important and need to be carefully monitored, because if they do move up, they can make the job of getting back to price stability so much harder. And third is that, the record there is a record of failed attempts to get inflation under control, which only raises the ultimate cost to society of getting under control. Hence the need to do this job now and keep at it. So those are three lessons. I would say more broadly, another really fundamental lesson is, to me, is that the structure of the economy is ever changing and highly complex. And, we see that today around the world. Many nations are experiencing the first high inflation in 40 years, all around the world. Different countries have different composition and backstories, but it's really quite global. And the question really is this going to be a temporary thing that's really related to the pandemic in some way, or is there actually something more structural and persistent happening? For example, if we're moving to a world where we're going to see more frequent, larger, and more persistent supply shocks for whatever reason, that will have critical and difficult implications for the conduct of economic policy and monetary policy in particular. So this is not possible to know right now, but it's certainly a question that looms. I mean, to sum it up, I would just say economics is not physics. There isn't any specific temperature at which the economy boils over. It does boil over from time to time. And when that happens, it often takes many years of analysis, discussion, and debate to reach general agreement on why that has happened. So the point is that we are always making monetary policy under high uncertainty about the structure of the economy and the path ahead. That makes our work challenging. It also makes getting it right very important for the people that we serve, and we do think about that every day. So our understanding of the economy has to evolve. As the economy evolves, as time passes, we do learn more, and I think it's okay to follow the evidence and change one's mind. I think advice to scholars young and old is that people shouldn't be afraid to say that they've changed their view and explain why. I actually find that refreshing when people say, my view has evolved in the face of the evidence. I guess one more word to close for those young researchers you mentioned, and this is a commercial for public service and for the Fed. So the Fed is a very special place where people can combine policy research with policy making. This is a place that all of us have a very strong sense of mission in our work, which is very satisfying. And that mission is to serve the public. And it really matters. Our work really matters to the public. I would say there's no higher calling or more satisfying mission. So I hope that young researchers and economists and others will consider public service as part of their career. For me, it's been only a part. But in particular, consider working at the Fed, where you'd be most welcome.
Thanks for that. I mean, I share those sentiments. As you mentioned your work at the Bipartisan Research Center, and I'm at Cato because I care about the future of our country and the future, of course, of liberty and freedom in America, and for the kind of world future generations are going to grow up, and whether they're going to have the same opportunities that we all have had to live in a free country and to pursue their American dream, and being part of that is a real privilege. I know, at Cato, we work very hard to raise consciousness of monetary policy and the potential for monetary reform. We wish that, we think this is a very important topic, and that more Americans should pay attention to it, even though it's complicated. We wish there were more policy organizations that would prioritize this policy area and raise their level of resources dedicated to this area. And as you know, Mr. Chairman, Cato is not shy about being critical, and we enjoy intellectually jousting with you and your team. But we also recognize that we share common goals and objectives for our country, and it's in the country's best interests by which that jousting and those debates and areas of disagreement. It's within that context that they occur. And so I do thank you for your work. You're in a challenging position, and I thank you very much for being part of this conference today. It's been a real pleasure.
Thanks, Peter. The pleasure is mine too.
Thanks so much. And with that, I'm just going to let all the viewers know that we're going to be taking a break now until the top of the hour. So we're going to reconvene.
Been listening to the chairman of the Federal Reserve. I still can't believe that the moderator's son-in-law is the Bitcoin guy from that Janet Yellen, Humphrey Hawkins testimony a long time ago. From New York City this morning, good morning to you all. Your equity market looks a little bit like this. We're down about 1/3 on the S&P 500. In the bond market, at the front end, yields climbing in both Germany and in the US as well. On a 2-year, we're up by about 4 basis points. On a German 2-year, we're up by about 12 basis points. In the FX market, euro recovers just a little bit, still negative 0.2% on euro dollar, 99.83. Got to do two things: talk about what Chairman Powell just said in the last hour and pick up on the end of that news conference with President Lagarde in the last 10 minutes or so. For the Fed chairman, very, very much focused on re-anchoring inflation expectations. Take a listen to this.
We need to act now forthrightly, strongly, as we have been doing, and we need to keep at it. And my colleagues and I are strongly committed to this project, and we will keep at it. It is very important that inflation expectations remain anchored. The clock is ticking. As I mentioned, the longer that inflation remains well above target, the greater the concern that the public will start to just naturally incorporate higher inflation into its economic decision making.
Mike McKee, the clock is ticking.
Yeah, except that in this appearance, perhaps the Bitcoin guy story is the only thing that qualifies really as news in terms of what would move the markets. The chairman was not asked and did not discuss what they're going to do at the September meeting. However, he did reiterate that they will keep at it, keep raising rates until the job is done. They don't take politics into consideration. They will not be bowed if Congress starts to put pressure on them because the economy is slowing. And he reiterated they want a period of growth below trend. That's maybe code for getting close to a recession, but not a recession. Now, Cato is a proudly libertarian organization that would like rules-based monetary policy making. Powell was asked about that, and he said no, particularly nominal income targeting, which Cato supports, is not the right formula. And he noted a sort of a new metaphor that monetary policy is not physics and there is no precise temperature at which the economy boils. And he said the Fed does not need to drop, Congress does not need to drop the employment part of their mandate. They're satisfied with their dual mandate. He was asked about cryptocurrencies and said they're a long way from deciding whether they would issue one, but they would not do it without Congress specifically authorizing it, John.
I'm still questioning the schedule for this Fed chair this morning, the counter-programming with the ECB chief. Anyway, Mike McKee, thank you, sir. The ECB president had a lot to say. What a tough, tough spot for Christine Lagarde. Upside risk to inflation, downside risk to growth. Take a listen.
That downside scenario differs from the current situation in that it includes, in particular, total shutdown of all Russian gas supply. Well, we're almost there. There's still a bit of flow going through the Ukrainian ones. But we also foresee rationing across the whole euro area and no measure of compensation between the shortage of gas supply and other alternative sources of supply. It's a really dark downside scenario, but it's one that concludes to a 23 recession.
Very happy to welcome back Maria Tadeo from Frankfurt outside ECB headquarters. Maria, the president got defensive at times about the forecast. Walk us through it.
She did, and I was very surprised by the language here. She was asked, there has been numerous issues now, numerous mistakes made to those forecasts, and she said, I take responsibility, I'm the head of the European Central Bank, but how would you forecast a pandemic? How would you forecast a war? And how do you forecast Russian blackmail? Nonetheless, that is her job, essentially, and every time they make mistakes, that is a problem for the credibility of the institution. Also, Jonathan, going back to your question, because I know this is something you took to heart, the fact that there was no reference to recession, she then went on to say there is a stressed case scenario that could perhaps culminate with a recession, but it's not the base case scenario, for the European Central Bank. And this is something the European officials will cling on tooth and nail. This idea that they still have cards to play and that they can still salvage this economy from a recession. When it comes to rate hikes, 75 basis points, she said it was unanimous and in some ways brought back the forward guidance. She said there could be more hikes to come, 2, 3, 4 meetings, less than 5.
Maria, thank you. In Frankfurt, Germany, a windy Frankfurt off the back of a 75 basis point rate hike. Your equity market just reversing losses a little bit. We're down about 0.1% on the S&P. The coverage continues. Thank you very much for choosing Bloomberg TV from New York City. This was the countdown to the open. This is Bloomberg.
The public seems to have lost interest in waiting around for self-driving cars. I rode in Google's self-driving car in 2011.
Wow.
And I'm still waiting to be able to buy or just ride a self-driving car on demand. Why is it taking so long?
I think in self-driving, first of all, the opportunity is so clear. The reach is so broad. We forgot that big things do start small. We all know how to drive, but we're driving amongst humans, and you have to deal with so many little scenarios. There are so many things that you've been learning about driving since birth. And codifying that using AI sensors and computers is turning out to be a lot harder. Last but not least, it's a safety critical system. None of us should deploy until and unless we have closed loop evidence that we're safe.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed, and he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumours that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the US.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, They claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful, and the stock had reached a value of 0, Wienergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Wienergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Wienergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Wienergold as an opportunity to leave that troubled home. Wienergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Wienergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not 0, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option, it would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable, it's transparent, it's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
What do you think is happening in the blockchain industry right now?
I think in the long run, DeFi wins. DeFi wins because it's a better system. It's composable, it's transparent, it's cheaper because you're just code. You don't have all these people in this legacy infrastructure.
What do you think is the future of the US dollar?
For the next 50 years, you are absolutely going to see a monetary revolution. But what you're going to see in the short to medium term is the strongest fiat currencies will hold on for much longer than we probably admit.
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the
more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Picking right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this.
I made the options video where I was like, options are just like shopping.
Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price?
And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're gonna watch and gonna stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind. But it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet. Because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed Harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out, They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up, and large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
of them 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as describe about. Hey Richita, how are you? Hi Sindhu, fine, thank you. And how about you? I'm fine too. It's very long.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Swaros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with the identity. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gauli Doddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have kabaddi, that the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.